You can see the screen, right?
Yes, sir.
Okay, fine. Okay. Now, today we are looking at trade financing. So I think we looked at what is trade operation. Uh, Today we are going to look at trade financing, how the bank comes as a facilitator to finance the international trade. So the objective of the today's session, by probably end of the session, you should be able to know the difference between, we will look at open account and advance payment, which we couldn't look at the previous class. Previous class, we went on a letters of credit or documentary credit, and we learned documentary collection, under which you have documents against acceptance, documents against payment. So we learned three methods, which is letter of credit, documents against payment, document against acceptance. When it comes to payment terms, though is three, you will call it as two. One is documentary credit, other one is documentary collection. Since documentary collection has two components, still considered as one kind of a payment. Now, the balance two kind of payments, open account and advance payment, we will learn today. So you will know the end of the session, you will know the entire payment terms used in international trade. Then credit facilities granted to importers and export customers. Yes, that is the key. If you are working in a in trade department or import export department, the key thing is how the bank facilitating both party, importer as well as exporter. That is what you call international trade. So how, what are the facilities offered, what are the natures of this facility, what type of securities are given, how bank facilitating different type of divergent requirement of importer and exporter, all that we are going to learn, right? And different type of charges, securities. Yeah, when you give a facility, credit facility, you know there are certain things bank take it to cover themselves. They take some security, so collateral or securities they take. When they take this collateral security, there's a way the charge is created. So example, if you're giving a housing loan, you call it as a mortgage. So same way, when you are taking, yeah, immobile property won't get involved generally when it comes to trade, because these are very uh, short-term finance. So eventually, you will take the most probably the exposure as the commodity goods, or if a recurring things, we will go for a limit. Then of course, immobile property comes in. But generally, when it with regard to commodity, it's goods. It's a movable item. So there are different charges comes in. So let us look at the charges also. Then you will have a pre-shipment and post-shipment. This is especially for exports. You give two type of facilities. You call before the shipment pre-shipment, after the shipment you call post-shipment. Then export credit insurance. That is, there is an organization called SLASIC in Sri Lanka. They support the exporters in uh, so many ways, right? So that also we will look at it. Then external commercial borrowing. They are the people who are into trade also as a facility to borrow from overseas lender. So that is you call external commercial borrowing. Direct, indirect, we look at the bank guarantees also today. What are the direct and international bank guarantees? Type of bank guarantees and its usage is very important in international trade bank guarantees, and understanding the contingent liability. So these are main objective of our session today. So let's start with financing of international trade. Yeah, when it comes to international trade, financing international trade, uh, the bank comes as a facilitator. You know, there are two parties in trade finance. There's one is called importer, who is the buyer, and there is other party called exporter, which who is a seller. Now, the bank comes in financing in both parties. Say, if an importer wants finance for his import, banks get involved. You know, letter of credit banks. I think previous class I explained, when it comes to letter of credit, when there is a payment obligation. I mean, the seller requests the buyer to open, or the exporter requests the importer, you have to open a letter of credit. Then the importer goes to his bank and keeping his facility, whatever, and open the LC. That is the facility. That's we are talking about. That is what in financing. So banks support the importer, right, to finance his imports, right? When the goods come, he might not have money, then bank comes as a intermediary or facilitator to support the importer. On the other hand, banks support uh, a number of ways to exporter, because exporter is the person who require more finance than the importer, because importer only wants to buy the things, but he need to open LCs in the event of a LC comes as a payment term. If not, it's only financing for its import. But when it comes to exporter, he's a seller. So he require more finance than the buyer. So the sellers only we have a number of facilities offered to sellers. That is what you call pre-shipment and post-shipment. So many facility because the seller require more. So the as a bank, they support both parties, importer as well as the exporter. So these facilities generally are short term in nature, because they are dealing in commodities. So these commodities are traded the lifespan of maybe 90 to 180 days, maybe maximum 1 year is the period. So the credit period are very short. It's not like a 3 4 year loan. So that is comes in as a medium and long term. So the generally when it comes to trade, the financing trade of 90% to 95% involved in a short term tenor. So this is kind of a short term. So bank comes in as intermediary, facilitating both parties. So banks comes as intermediary by opening an LC. You can see the bank's role as a not only opening LC, when it goes to the seller's country, there is a bank advising LCs. There again, they're supporting. And when it comes to after shipment, the exporter hand over the documents, the bank financing the exporter immediately. That is also kind of a financing. So when it comes to finance, you could see the banks involved in both end, importer as well as exporter. By opening an LC, they are financing for importer. After shipment, when the exporter wants the money immediately, and the bank again financing, right? Maybe sometime when the exporter get the LC, he doesn't have any funds or working capital to execute the order. Again, bank financing. That is you call pre-shipment, before shipment. And the bank also can support after shipment. After shipment, by bank supports, generally what happens, the exporter might give a credit period to the importer. So when he exports, the export is ready, when he ship the goods, he knows he won't get the money because he have already committed the importer 30 days or 90 days or 180 days, a specific credit period. uh, so the money will come after the maturity of that particular credit period. Let's say if the exporter given 90 days credit period, 3 months, then the importer will pay after 3 months only. But in the meantime, if he gets the other order, then his capital is blocked, because he has given 3 months credit period to importer. What happens if he ship the goods? He has to wait 3 months. So he has to continue to operate. So bank come as a facilitator. So you must understand here, wherever there is a gap to get the money, the banks comes in. So now see, there is a gap. When it open the LC, until the goods come, the importer might not give the money. So he expecting bank to open the LC. When the goods come only, he has to pay. So until such time, he needs the funds, he needs the facility. That is what he comes to the bank and asking bank to open the LC. He knows at the time of opening the LC, goods might come at the 1 month's time. So he can't block his capital. We have so many import is done. So what happened? He wants a facility from the bank. So this is what bank is comes as a financing international trade. Wherever there is a gap in getting the payment or executing the payment, banks offer that in the form of finance to cover the gap, to bridge the gap. That is where the financing always bank comes. So and also you understand by now, the banks are not dealing with goods at all. Banks are dealing only with document and facilitating the payment. That's all bank can do. So bank will make sure a good set of documents as per the terms and condition of the documentary credit, or in the event of a collection, a set of documents have been gone through them, and they verify the authenticity and pass on to somebody. So here, the both parties should understand each other. So the importer should understand, when you open the LC, is opening the LC for a reputed company. Because just because of opening the LC, exporter get the cover, because he knows the importer's bank open the LC, he get the cover. But also the importer also should be mindful whether after opening the LC, whether exporter will meet this requirement. Right? So many cases has happened after opening the LC, to see the exporter is not a good person. So he has shipped something else. He promised something else and he shipped something else. So there are so many court cases, even in Sri Lanka, this has happened. Our importers have got inferior goods imported, or sometimes they promise something and send something very low quality or not at all usable commodities, but they got the money away. So at that time, banks role as a facilitator only. So bank is not dealing with physically what is coming in a container. Bank can't do that. The bank doesn't have that much of resources to do all these things. So banks are in general dealing with documents. So you should understand, when bank comes as a facilitator, they simply involving in the process of making the payment and exchange the documents involved. That is their role. That is their key role. So they don't deal with physical goods at all, right? So that is the fundamental of financing international trade, right? So bank role as an intermediary. Okay. So as you know, as I told you, uh, the the banks involved in different payment method. We have learned, right? So we know the different payment method used in international trade, like LCs, DP, DA, and we are going to learn today two more payment term, advance payment to open account. In these two payment term, remember, bank don't get involved documents. Bank only come as a facilitator of payment. So if you put all the payment method together, summarize the banks, what is the bank role? Banks comes as a facilitator between two parties to execute a payment. So the bank comes and assure this guy will pay you, no worries, provided you meet this obligation, you meet these terms and conditions, so that the buyer is also safeguarded, the seller is also safeguarded, right? So the both parties, there should be some intermediary reputed organization as comes, so that the both parties are comfortable to deal with. So that is the role called facilitator, right, or intermediary. That is where the bank's roles has. And for you to do for that to support the trade, the bank should have definitely a relationship with bank. This, I think, the first class we learn. I think we are going in a sequence order. First class, we know the correspondent banking, how important it is, right? So whenever some exporter in Sri Lanka exports something and he wants the documents to go to a particular country, and he can't send it directly, it has to go by bank, documentary collection, documents against payment, and documents against acceptance. We learned that. So it has to be channeled through the bank. So the bank should have a correspondent relationship to do that, right? And if our Sri Lankan exporters are doing export to various countries, the banks here should have a relationship in all those countries, banks in all those countries. Otherwise, we won't be able to send these documents to them, and we need to communicate to them. So that is what we learn: correspondent banking. What is SWIFT? That is a mode used to communicating to each other. And not only that, you need to have an account relationship, Nostro, right? So these only the Nostro account through which the payments are facilitated. So whether the export, whether the import, we need to execute the payment. Whether the bank can send the payment or bank can receive the payment. If it is import, bank has to send the payment. If it is export, the payment will come in. So we will receiving the payment. So by selling goods, the exporter, by selling goods, exporter will receive the money. So the funds are flow through the banking channel, right? By import, by opening an LC or by importing, we need to make the payment on behalf of the buyer, on behalf of the importer. The payment.
Sorry, we don't seem to be navigating anywhere. If you'd like directions, just say.
Sorry. So the banks. So the bank's role here need to be understood properly. Not only facilitator, through their correspondent network, they facilitate the trade. So sometimes
Interesting question.
difficult periods. The currently you see that currently you have issues where the current scenario, we will have a difficult time. Just hang on a second, please. Sorry for the disturbance. Right. So here in the difficult period, uh, the bank using their correspondent network trying to facilitate transactions, especially the current scenario. If you take it, banks are find it very difficult because the moment our country credit rating is downgraded, the banks that have been supporting us also have a reservation. Basically, what they look at the risk element. It's a credit. Is this country is capable of repaying this obligation, the financial obligation? So that is what the credit rating agencies are giving ratings based on the country credibility or credit worthiness. So when the credibility is a doubt, then there is an issue. Even with the existing correspondent relationship, we will have a tough time. We are asking them to support us. Why it is? Because when the ratings are downgraded, that gives the indication to them there is something going wrong here. There is something alarm. There is some alert. So when the alert is thrown, so the bank need to be a bit careful. So that is where the tough time the importer exporter both are facing. Especially the importers find it very difficult to settle that, since we have this foreign exchange issue. Most of the importers need to wait until to make the payment. So there are situations uh, they might ask times 60 days credit period, because the government regulation says you can't make immediate payment. So all the supplier has to give the credit period. So when they give the credit period to our importers, whether they will think whether maturity, whether are they in a position to get the money back. So there are situations which the banks are facilitating this trade purely because they have the long-standing relationship some of the bigger banks. So that is what even still we are in a position to continue the trade, though we are in a bit of a difficult position when it comes to economically. Uh, and in this type of environment, even we are in a position to managing. That is because we have a good relationship, set up good relationship with the bank. So still they are supporting. But remember, there are few banks who have said they are unable to do it because of the current situation. So that is where uh, the external factor comes in. So though banks are willing to support, the external factors like independent credit agencies, when they rate the credit rating of the country, if it is downgraded, that issue always there. So you need to be mindful of that situation too. Okay. So international trade transaction credit is provided by the supplier. Yes, the supplier provides the credit. As you know, in payment terms, deferred payment, acceptance term, they are always the supplier give the credit period. The exporter give the credit period to importer. Okay, you sell it and you buy the goods, collect it, clear it, sell it, and pay me later. So there could be 90 days, there could be 120 days. It's a credit period given by the exporter himself direct to the importer. Sometimes the importer will provide the cover by making advance payment. That's what we are going to learn now. Importer might make the payment advance to the exporter so that he will have a funds to uh, procure the goods and manufacture and send it back to importer. So, so that kind of a commodity also tradable. These are overwhelming demanded goods like machinery, some of the machineries, uh, some of the uh, technologically advanced equipments may be great demanded. So the seller might say, you need to send the money first, then only I will manufacture. So there's no choice. The import has to make advance payment. Then the seller will manufacture and send it back. So in that case, importer is financing. Importer is doing a payment. So the seller will collect the money and do it and then send. So importer taking a huge risk over there, right? So that is also possible. Sometimes banks does. Yeah, banks comes with that opening LC, bank financing, or combination of a bank financing and either import or exporter can support. So these are the way the international credit, whenever there is a credit period is provided, the financing in comes in, right? So you should understand when the financing is comes in, whenever there is a gap, when you sell the goods, domestically you don't have any problem. But when it comes to international trade, you should know goods are going from one point to the other country over there. So it will take time. There is payment also, there is a delay. And on top of that, exporter given the credit period to the importer. So there's a credit period involved. So he also need capital to do the other orders. So that is where wherever there is a gap, bank comes in as a facilitator, so that there will be smooth fund flows are there for both parties. Yes, basic trade finance. If you really look at the trade finance as a facility, the true lifeline is the short term. So it's very short term tenor. Uh, Basically, it's within the period of 90 days to 180 days, general 6 months, or it may extend it to maybe little over 180 days exceptionally. But it has to be generally very short. So short term means 90 to 180 days. That is the tenor generally when it comes to import. Unless otherwise you order sophisticated machinery, which might take time to manufacture. Maybe 1 year it might take, right? Generally. If not, the trade is 30 days or 90 days is more than enough. Or it might go up to 180 days at a little lengthier period. But everything under 1 year is considered as a short term. For your terminology, when you use the short term, anything short term is within 1 year considered as a short term. 1 year to more than 3 4 years can be medium. Anything more than five, it will be longer term. So longer period. So a trade generally considered as a very short term. So the importer exporter both are enjoying the short term finance. So basically, when it comes to trade, for any matter, there are three key factors. What are the three key factors in financing? When you finance, there are three key factors you look. One is circumventing the risk, avoiding the risk factor. Then the cost factor. So remember, the risk factor and the cost factor and the executing the payment. These are the key area in any trade. So you need to make sure the transaction is done at a very lower cost. And wherever there is a risk, you need to mitigate that risk, avoid that risk. So risk is there, cost is there, then affecting the payment. In international terms, you will affect the various type of required currencies, because this is a cross-border transaction, because you are buying or selling from a person outside Sri Lanka in other country. That is what you call cross-border transaction, right? So here, uh, so the bank's involvement in executing the payment. But in the meantime, they will also ensure trying to keep the risk mitigated. That is where you need to take insurance. You need to take some collateral when you give a credit facility. So bank trying to cover that exposure, right? Bank, whenever bank financing, because the you should understand whose funds bank financing. It is the depositors' funds. So the bank is responsible for the depositors. When the depositors' funds are used to give a various credit facility, end of the day, banks should ensure these funds are collected back from the debtors or from the importers or the borrowers, because these need to be repaid to the depositors, because the depositors' funds only the bank is uh, utilizing to give varieties of credit facility. So it is the depositors' fund. So they must ensure the risk factor is always covered and keep the cost at a lower cost, so that it will facilitate the importer exporter be competitive in the market, right? And facilitating the payment, right? So and and if you look at the any trade firm, they have their own capital, but as a working capital, since bank financing, they need not to utilize their capital. So if you take unlike a bank and a organization, normal business organization, what is the difference? Banks utilizing the depositors' money to do businesses. That is the banks. That is very unique. But if you take a normal business firm, they have to do their own funds to do their businesses, because they can't borrow depositors funds. They have to use their own funds, right? So that is maybe put by the shareholders. If it is a public quoted or private company, the stakeholders will put the money, and with that money only they can run. If not, the money is sufficient, they go to the bank. This is where the banks comes in. So if they don't have enough funds to run the business, they have to go to the bank. So that is where the bank is supporting the trade. So the by nature, these are short term. So the bank can support them by financing short term. It can be overdraft facility, it can be import loan facility, all are in short tenor. So that short tenor will assist them to cover their working capital. These are you call working capital. Working capital mean in any businesses you have a current assets, right? current assets, you have a current liabilities, right? So current assets are generally your stocks, debtors, cash, bank balances are current assets. Current liabilities are your creditors, your bank overdraft facility, your accrued bill payable, all that is current liability. So from your current asset, you minus the current liability, the difference is your working capital. General perception is your current asset should be double the current liability. If your current asset is 100, the current liability should be 50. It is general perception. Business to business, this proposition differs, right? But in when it comes to trade, the working capital should be sufficient for an exporter to do his order, or importer when he buying import and selling into the market, he need to have a working capital. So this is where banks comes in and make that working capital cycles effective by financing them, right? So let us look at the two payment term which we not learned last year, because there is a reason why we are learning today, because bank do not get involved in exchanging documents in these two payment terms. So open account, what is this open account? Open account mean here what happens, the exporter sends the goods to the importer, right? There is an arrangement between these two parties. The exporter ship the goods direct to consign to the importer. Banks do not get involved. He ship the good direct to the importer and send the documents also direct to the importer, not to the bank. Right? So the documents are goes to the importer. Now, when he gets the documents, the importer, here what happens? The exporter has taken absolute risk by sending a shipment to importer, trusting that guy will pay very much later. He will collect the goods, go and clear it, and sell it, collect the proceeds, and then make the payment. So you could see why the exporter taking such a huge risk in open account. So you should understand there are certain commodities which there is no market at all, not immediate saleable market, no great demand. So there are slow moving goods. So what happen if you are a seller apparently involving in such commodity, you don't have any other payment terms to sell this. You will simply sell, say for example, books, read materials, books, periodicals. You send it on, you are printing so much of books. So what you will do, you send the consignment of books to import in Sri Lanka, he will go and clear it. Remember, when he goes and clear it, he won't pay any money. He simply go and clear it because the payment term itself says open account. So when he goes and clear, so at the time of clearance, you will have countries to countries have a different different formation, different procedure. In Sri Lanka, if the importer goes and clear, he has to declare at the customs that he will make the payment subsequently through his bank. He has to mention the bank. So the customs will allow him to clear the goods. So the importer do not pay anything. The goods have shipped direct to him. He get the documents, he go to the customs and clear it, and he'll tell the customs people, I will make the payment subsequently. So only thing is he has to mention the bank. So let's say he will say my bank is Sampath Bank. So he goes and clear it. And when he sell the good, he collect it and then he put it to collect the goods and he sell it and collect the money, and then he decides to send a part of the payment, not maybe full payment or the part payment. He can send it. When he wants to send the payment, then only the banks comes in, because he can't directly send the payment. He can directly collect the document, but banks comes in as to facilitate the payment. There's no other way he can send the payment, right? There is no other way. Every trade payment has to be done through the banking channel. That is the mandatory, right? So what happens? The import has to come to the bank to make the payment, right? So when he tries to make the payment, he has to show the bank that he has already cleared the goods. So that is what he need to show. There is a custom declaration that he has cleared the goods, and he shows custom declaration, and he will make the payment, right? And yes, he would have mentioned in the customs people that he will make the payment subsequently through Sampath Bank. So when he goes with a custom clear document, and the Sampath Bank will make the payment, and the exporter will collect the money. So you could see in the open account arrangement, who take the highest risk? Obviously, the exporter. This is a totally high risk trade term, open account, because as I told you, there are different commodities involved in trade. There are certain commodity which has no demand at all when it comes to global market. It's very slow moving, but it's maybe essential, but the nature is such. So that is the reason you could see when there are great demand for certain commodities, they will say either DP or collection or LCs, they will use this. But there are certain commodities which are very slow moving. So the making payment is not possible by the importer immediately. You need a little bit of time, because he need to clear it and sell it and recover, because he won't utilize his capital, because it is a blockage of his capital if he immediately pay and collect it. Say a publisher, Vajira bookshop, or you can take whatever bookshop, which is a APA. These bookshops have enough books, right? So remember, these periodical books are not paid by them. They're imported and they put it into their outlet. Whenever those books are sold, they collect an amount and then part by part they remit to the distributor or remit to the supplier. So that is what the open accounts is very convenient terms to use it. So you should know open account is where the payment will absolutely made after the importer sell the goods and recover the money, right? So what happened? It's give a very competitive advantage to the importer, because he doesn't need to put his working capital at all. So he simply get a credit period. And on the other side, when it comes to exporter as a market, because there are people who are willing to buy on an open account terms, right? So what happens? These goods are now, if you really look at Sri Lankan perspective, some of our exporters are doing an open account. We are sending the goods to buyer, and they will sell it, and later only they will pay. So most of our exporters are doing it on open account, because the export commodity is such very not highly demanded goods. These goods are, right? Maybe tea, coconut, rubber. Some of the exporters are doing it on open account. Otherwise, they might not have the market to sell it. So these are commodities which are very slow moving. So the seller doesn't have any market. He has to compromise, and the importer will take the maximum advantage in the open account, because there's no other way. He also can't, because this is a very slow moving in nature. Or sometimes the importer, a bit of highly demanded person, he can dictate terms to the seller and say, you, if you send it on open account, I'll buy. If not, I don't buy. So there are situations that could uh, maybe the negotiation capabilities of importer is very much higher than the exporter. Then he might dictate terms, I will buy. Then exporter, if they doesn't have the market, they may have to agree to sell it on open account. So in open account, who take the high risk here? The exporter. It's a fully advantage to the importer. That is open account. So what happened when it comes to open account? Let's say an exporter send the consignment of books to Sri Lanka. Now he has the document. He send the goods, right? Now he has receivable from Sri Lankan three bookshop. He has sent it to three bookshop in Sri Lanka. Each consignment is 100,000, 100,000, 100,000. Now look at the exporter's point of view. He has three bill outstanding from Sri Lanka, 100,000 each. This might give him other 6 months time to get this money. Now, what he will do, there is something called factoring. These are way of financing. There will be some companies, they will take over this outstanding receivable from the Sri Lanka, and they will finance the exporter, and they will collect the money. Of course, they will charge a fee, kind of a discounting. So the exporter who send it on open account generally has, he need not to wait for 6 months or whatever to recover each 100,000 from Sri Lanka. What he does is he go and sell that invoice to somebody. That is, they are going to learn as a factoring. So factoring means there are finance institution, there are credit agencies, institution. What they do is their job is to buy receivables and make the payment, and they will ensure they collect the money from the ultimate buyer. But of course, they will, since they are blocking their money, they will negotiate a very attractive price, which is advantage to the companies. That the creditors, fine. But if you look at the exporter's point of view, at least he get though he discounted and get a lesser amount, he knows that he will get the money. For that, he will use that money to do the manufacturing of next consignment immediately rather than waiting for 6 months. So the factoring is ideal for the exporters to discount the invoices if he given the credit period to the importer. That is open account, right? Then we are going to learn just opposite to the open account, advance payment. So it is totally other way. It is totally other way. Now, importer doesn't have any say here. Now, early instant, exporter doesn't have anything. He has no option just to send the goods to the importer. Here, the other way. Now, exporter is highly demanded goods. Now, exporter says, you send me the money first, then I will manufacture and send you the goods. So here, the importer has to send the money well in advance to the exporter. So he comes to the bank and asking the bank to send the money first. So banks comes in when it comes to advance payment without any, he bring the invoice and he will ask the bank to remit the money. So here money going, if you look at Sri Lankan point of view, if somebody making advance payment, if the Sri Lankan importer has to make the payment first before the seller or the exporter send the goods to Sri Lanka, the money has to go first. That is you call advance payment. The word suggests advance payment. So you are making the payment. So importer makes the payment to the exporter. So here, who is taking a fully advantage? The seller. Simply seller gets the money before even goods are ready. He gets the money because the goods that he involves are highly demanded. So he dictates terms. Early instant, the previous open account example, the seller didn't have any market. So seller has to sell it on open account. But if the goods are highly demanded, just opposite to open account. Advance, you ask the importer, you send me the money. There's no way the importer can buy these goods from anywhere. So he has to agree for this open account advance payment term so that he will send the money, and then he will remit the money through the bank, and then exporter collect the money. He will manufacture the goods and ship the goods, right? So here the great risk is taken by the importer. So open account, great risk taken by the exporter, but in advance payment, importer take the fully risk. The exporter is most in beneficial position. The very, very competitive advantage for the exporter because he received the money before even prepare the shipments. That is what is called advance payment. So these are generally rare nature or very high demand goods. Overwhelming demand mean key, very high demand goods, great demand. So there are commodity like machineries, maybe laptops, you can say, devices, electrical devices, electronic devices, mobile phone, all these are demanded goods, right? So people need to dictate terms. These manufacturing companies might dictate terms. You better pay. We have enough companies to buy our goods. So this is where we need to target. If we are a developing country, if we are to improve our country's foreign exchange position, we need to not to export goods on open account. We need to make the goods exported under advance payment. This is where we need to aspiring to go into this level. So when we have a manufacturing plant, when we have this electronic device manufacturing entities here, then we are also in a position to get into this kind of commodity so that we will have a dictate terms to the entire globe market. You better send the money to us. We will send you the goods. So currently, this kind of commodities are very rare from Sri Lanka. We won't be able to get any advance payment before the shipment. Very rare occurrence. Maybe one or two, we don't know. Maybe gem and jewelry that also don't. Without looking at the commodity, whether any importer willing to make the payment also questionable. But generally, no. So if you look at the developed country like Japan, China, USA, they have enough of plenty of commodity, including vehicle, machineries. They simply great demand. So they will always dictate terms, send us the payment, we will send you the goods later. So they have a competitive advantage over the other countries by having a highly demanded good manufactured within their country or utilizing the latest technology to involve in such commodities. So that is called advance payment. But since we are making the payment in Sri Lankan context, we have certain regulations, right? So you can't simply send the money and wait, because we don't have foreign reserve already. So how come we can send the money and wait? So we have a regulation in Sri Lanka. When you are sending advance payment out of a rupee account, there's a limitation of $50,000 equivalent. 50,000 US dollar or its equivalent is the limit you can send out of a rupee account when you are making an advance payment. You can't send more than $50,000. If you want to send more than $50,000, then what happen? That particular exporter has to give you an advance payment guarantee. Or else, if you're having a foreign currency account, you can do that from your foreign currency account, like offshore account. Uh, if you have a business foreign currency account, you are in a position to do that out of your foreign currency account, not from your LKR account. So if you are a importer, you want to make an advance payment, remember there's a limitation of $50,000. So there are question asked whether this 50,000 limitation can be broken into two shipments. No, you can't do that. Sometimes some customer might come and say, I want to remit, let's say the consignment value is 65,000. So you know there's a 50,000 only. You can't do more than 50. But let's say there is a guy demanding 65,000. That's one of the exporter demanding from Sri Lankan importer. You send us the 65,000, we send you the laptops. Entire thing should come 65,000. So there is a limitation. So bank should not. So what happened if the importer comes to the bank making the invoice 30,000 and 35,000? That kind of advices are given by the bank to some customers. So that is not correct. So you can't do that. You can't break the invoices, because what happened, though you make the invoices to reduce it to 50,000 and make four invoices, when you add it up, it's exceeding more than 50,000, but all that consignments are coming in a same vessel, same ship, then it treated as a one shipment, right? So you must understand these rules should not be uh, override and trying to give a advantage to the customer by breaking the payments. No, you can't do that, because what happened, I will give you an example for you to better understand. Let's say a Sri Lankan company A want to buy this, right? The amount is, let's say, 70,000. Advance is the seller is insisting advance payment, right? So the A is the importer. He has to make the advance payment of $70,000. B is the seller. Now seller insists, I want the 70,000, I will send you the goods. So the one choice is, its answer is no, you can't do that. That is first thing. Or second, yeah, it is possible, provided the seller sends the advance payment guarantee. Because what happened, our regulator says, when you're sending 70,000, you should get advance payment guarantee from the seller that in the event he doesn't ship the goods, there's a loss to the country, because you are sending $70,000 out of our money before the goods come. What happened if the seller doesn't send the goods? There's a risk to the country. We are lost the 70,000. So if the good doesn't come, there should be a way to claim this money, what the importer sends to the exporter. So that is what the regulator says. Okay, if you want to do more than 50,000, there should be a bank guarantee given by the reputed bank from the seller's country, so that you have a comfortable. Uh, if we are remitting more than 50,000, there should be a bank guarantee. Or the 50,000 is only possible by making the payment out of foreign currency account, not from the LKR account. So if you are making, trying to break this regulation by breaking the invoices, we got to know some banks has done this, and they have been penalized by the regulator, right? So they have gone and break the invoices into three invoices. Let's say 70,000, you can make it to 30,000, 20,000, 30,000. Below 50, all three invoices are 30, 20, 30. 30, 20, 30. That comes to about 80,000, right? Or 30, or 25, 25, and 20. So it comes to 70,000, right? So you make 25, 20, 25, all 70, all three invoices payment is done. Remember, when you're making a payment, you must ensure these 25, 20, 25 not coming in the same vessel. If everything comes in the same vessel, it considered as a one shipment, then it become a violation. Because what happened, the exporter is one same person, the importer also same person, in the same vessel, whether the invoices is broken into any number, everything considered, every invoices will be added up, and if that is exceeding 50,000, you will be fined. So you should not make the payment out of by breaking this limitation, right? You have to be very careful. So the goods that when you're making an advance payment, there's other requirement regulation here. Within 180 days, within 6 months from the date of remittances, goods should come, right? Goods should come. But they are given an exceptional where in the event of if you're importing a machinery, heavy machinery equipments, they are given 365 days time period, because certain time what happens when you give a specification, the machinery manufacturing organization, international company might take little longer than 6 months. It may take 9 months. So you really require period. Though you send the money in well advance, they will take their own time to manufacture. So regulator given, okay, if in the event if you're importing a machinery, though you remit the money, within 1 year period, you have to bring the goods into the country. So you have a 1 year period. Other than the machinery, everything has to come within 6 months from the date of the remittance, from the date of payment. Within 180 days, goods has to come to Sri Lanka, because they want to ensure the money that been sent out, equivalent of the goods have come into the country. That is the regulation. Okay. Even if there is a mix of advance payment and the letter of credit, still the goods has to come within 365 days, right? Sometime you can mix this advance payment and letter of credit, right? So what happened? The importer says, the exporter says, you send me the advance payment first, then open the LC for the balance amount. So he wants some money for him to receive and start the manufacturing. Later, he says the importer to open LC. So he covers. Let's say the machinery value is 100,000, right? Advance payment is 20,000. Balance 80,000 through the LC. That is not a violation, because you send the advance payment below 50,000. Because you should not exceed 50,000, because you send the advance payment only 20, balance 80,000 you are doing an LC, so that doesn't violate. So it's not violating, because you are well within the 20,000, 50 below 50,000. The 20,000 advance payment only you need to consider. That is not exceeding 50. Mean anything balance going in any other payment terms doesn't consider as a violation. So you need to be aware of. Okay, now let us look at types of credit facility granted to trade customers. So actually, I have given different colors since I made it as a slideshow. This working capital is one color. The right mark, what I put is one color. And the first three, letter of credit, term loan issuance, these first three are for importers. So the first one, working capital is 4. If you want, you just jot down the points. Working capital for both importer and exporter. That facility is for both importer and exporter. Is a common facility, overdraft facility. The second, third one, that is letter of credit, term loan, import and term loan, issuance, shipping guarantee, only for importers. The entire others, from export credit to the forfeiting, until forfeiting from export credit, everything to the exporters. So you can see number of facility that is granted to exporters are much more than the importer. Because importer, you only want the money to clear the goods, that's all. But when it comes to exporter, he must be dealing with different countries. He wants a working capital. He is the seller. He wants to manufacture various goods. There are different buyers, agree for different payment terms. So he wants so much of facility from the bank as a seller, because seller only wants more facility than the buyer. Buyers only want to buy the goods, that's all. As far as importer is concerned, if he has import loan or LC facility, that is sufficient. But when it comes to seller, exporter, you need a lot of working capital, because you are by nature of your operation, manufacture and send the goods, sell the goods. Let's say if you're a garment factory, you import raw material, you manufacture, you export. You import raw material, you manufacture, you export. So there are different payment terms you agree upon the importers, and you buy raw material from different people. You require so much of facility from the bank. That is what so much of divergent. You can see the different facilities are offered to exporter, because the nature is such they are involving in different payment terms and with the different parties. That is what all these facilities are given: pre-shipment, post-shipment, discounting, foreign currency loan, external commercial borrowing, invoice discounting. All this is uh, so let us look at one by one, right? So it's not a big thing, simple. So overdraft facility, which is a common for importer and exporter, both is common. Overdraft facility can be given to the bank. You know what is overdraft facility? When you have a current account, you have the facility to withdraw money more than your balance. So your balance become a minus, right? That is overdraft facility. So this is the exceptional given only for the current account holders. So every businesses will have a current account, and it is not exception. Importer or exporter, they will have a current account. So they will have a facility whenever, let's say, if there is some importer, he need import 100,000 Sri Lankan rupee, 1 million goods have come. He doesn't have money, so he has OD facility, right? So he has to make sure when he use the OD facility, it bit expensive than import loan. So it's up to him whether to go for import facility or whether to go for overdraft facility. He need to calculate it. Bank point of view, if you offer a security, they will mark a permanent overdraft limit and he can utilize it, right? But he must ensure at what cost he is using. He need to do the cost structure. So that is where it's important when you go for overdraft facility for a short term. Yes, short term, yes. For a very short period, yes. But you need to have a permanent other facility if you are going for overdraft facility. It's a bit expensive because overdraft means you're offering, especially if you offer some security as a collateral to the bank or mortgage some property, and you will have a permanent limit, then of course you will negotiate the bank and have a reasonable rate. But it's still worthwhile to check it whether you can take an import loan lesser than this. Then you go for import loan. So this is a common overdraft facility. Even exporter also can have this facility. If you want, if you get an order, you don't have any money to buy, you overdraw the current account and buy the goods. But make sure when you're overdrawing the current account, what is the interest you are paying? Whether is there any other alternative financial channel available for you to borrow at a cheaper funds, you go for that. So this is a bit expensive, but it's already available, very convenient. You simply have a facility, you overdraw from your current account and buy. You have a permanent OD limit. So you know that is TOD, POD. Yeah? Temporary overdraft is called TOD. Permanent overdraft is called POD. So you will have a POD by mortgaging and assets. So you call collateral security. You need to provide security for you to mark a permanent limit. Temporary mean is clean basis. So unless otherwise very temporary, the banks give you. It's highly risk because clean basis mean no security is offered based on your credential. Bank might give a temporary OD for 1 or 2 days. So that will not going to suffice for you to do the trade. When you are doing a trade, you need to have a permanent overdraft limit marked for you. So this facility is a revolving facility. What do you mean by revolving facility? Even a letter of credit, if you have a limit, you keep on opening and utilizing. What do you mean by revolving borrowing facility? You keep on using this. Say, for example, if overdraft limit, if an import has overdraft limit of 1 million marked, he has given us some property and at a limit of, let's say, for example, 5 million, for example. So 5 million, he can anytime overdraw. So what he does, he write a check. His balance become, he wrote and pull out the money 1 million. So he can go other further 4 million. He draw other check 1 million. Now he has a limit of 3 million. In the meantime, he deposits some money. His incomes are coming. That is also deposited to the account. So when the deposited to the account, his overdraft limit now goes, because what happened, 3 million only he can overdraft because limit is 5. He has already taken 2 million. Since he's deposited the money, the check overdrafting facility now increases by the deposited amount. It's not, he has deposited, let's say, the 1 million. So he doesn't have 3 million. Now he has a 4 million facility. Why? Because the 3 million he has a limit, 1 million he has deposit. So he can again utilize that limit. And again, he deposit the money. Again, the limit can be utilized. So likewise, you keep on rotating this facility over and over again. That kind of facility called revolving. Current account overdraft is a revolving facility. If you have a LC, it's a revolving. If you have a credit card, personal capacity, if you're using a credit card, you have a limit. You keep on overdrawing. You keep on utilizing your credit card. You settle your payment and again you start utilizing because you are within your limit. That kind of a facility called revolving. So overdraft is a revolving facility. Only thing is bit expensive as far as the interest that offered by the bank is bit expensive. You need to be aware of as a importer or whether you are exporter, a bit of a expensive finance by taking into overdraft facility. That you need to be mindful, right? Overdraft is a good way of taking security, very convenient, but there again, the cost factor is need to be considered before you avail this facility, right? So let us move on to the letter of credit. Yeah, this is again, if you're an importer, if you're a regular importer, right? If it is a one-off case, you don't need to go for a limit. If you are a regular importer, it's always better to have a limit. What do you mean by limit? So what do you mean by limit here? So you go and mortgage a property to the bank, your building, business building, and ask the bank, okay, I am mortgaging this. I want a 10 million limit for my import LC. I'm an importer, import material and manufacture and sell it. Or I may be, I'm importing a finished goods, I'm selling to the local distributor and making money. So you might have a different type of imports, right? So whatever you do, you need to import, right? You need to you may import raw material, you may import finished good, you may import intermediary goods, whatever the goods may be. You need to have a limit when you're importing regularly. So you need to have a letter of credit facility. So how is the limit is created? You mortgage a property and you mark a limit of 10 million, within which you always open LC, because you have a limit marked for 10 million, under which there's no money is required. Your limit already, your property is mortgage, you have a limit of 10 million. So you, like credit card, when you are given a limit of 1 million, you can use the card anytime, provided you are within the limit. You use the card and you repay. You use the card, you repay. So that is kind of a revolving. So same thing, letter of credit facility also something similar. So you ask the bank to open LC. Whenever the seller says for you to open LC, then you go to the bank and open the LC. What happened when you open the LC, your LC limit is utilized, right? When the goods come, if you have money, either you will pay or you might go for an import bill. That's your next facility we are going to consider. If you are a guy, you don't have enough funds, then you are mostly depending on the bank finance, then you will have a letter of credit facility as well as import facility. Some people might go for 10 million both together, combined, both together 10 million. Either they will use the letter of credit and import bill together 10 million. They will have a combination of both together. Or they will have a separate limit for 10 million LCs, 5 million import bills. Either way, whatever preferable, whatever economical for them, they will structure the facility in such a way so that they will have a letter of credit facility for 10 million. If they have import bill facility 5 million separately, what will happen? When you open the letter of credit facility, it is blocked against the letter of credit facility, you open 2 million. So take example, 2 million rupee worth of LCs you open. You have a 10 million rupee facility. 2 million worth of LC you open. Now goods have come. When the goods have come, you need to pay the money, right? Then what will happen? You ask the bank to give import loan for that. So the bank will grant import loan. Then what will happen? The moment import loan is granted, your LC facility become again 10 million. Why? The LC liability is now over. It is shifted from LC to bills. So your LC liability become 10 million again. The 2 million is gone into bills now. Then you recover, you clear the goods, you sell it and repay the import loan. Then you will import loan back again 5 million. Then you have a fresh limit again. Then you open LC. Then LC limit will be utilized. Then when the import comes, you take an import loan. Or sometimes without import loan, people only have a LC limit. Or they will have both. Or they may have a combination of both together and say 10 million, combine both together, 10 million at any given point of time. So they can interchangeably using both limits. But both total should not exceed 10 million. So you can interchangeably use that, right? That is how the facilities of letter of credits are concerned. You know what is letter of credit? Banks facilitating payment undertaking to the exporter, because the exporter insists the LC to be open for him to ship the goods. So the importer comes to you and asking you to open LC. So you open the LC on behalf of the importer, favoring the exporter. So that exporter is now convinced because the obligation is from a bank. So if he meet all the terms and conditions set in the LC, he will be paid. That assurance is given by the bank on behalf of the importer. So the moment you open the LC, seller will ship the goods and he goes and get the payment from the nominated bank, right? That is how. So the LC in such a way, this is the most usable product when both parties are have, will not have that kind of a trust relationship, or maybe beginning of the trade. Their trade relationship just a fresher at a very infant level, starting level. So they switch on to letter of credit. Maybe they go to the other payment level when they have a trust relationship is established. When they are having a trust each other, then may switch on to other term. Until such time, it's better to deal with letter of credit. Both parties are covered because the seller covers because the importer bank has given the assurance, and the import also covered because the importer when the import bank open the LC, they also given undertaking the seller, you better ship the goods and send the documents to us, then only we will pay. But the document need to be complied to the terms and conditions. So that is checked by the bank. So the seller, the import also protected up to certain extent, the documents are coming. That is meeting all the requirements, so that both parties are covered in LC. That is the reason when unknown people are getting into trade, is always the better payment method should be letter of credit. All other terms and conditions are coming thereafter, right? So these limits are, you regularly review the limits, because depending on the utilization of the limit, right? So, okay. Term loan. This is again other facility, which is, any businesses, businesses and loans are inseparable, right? So no businesses can do their businesses out of their own funds, because they have to borrow from the banks, right? You don't do business. There are some businesses very exceptionally do their businesses out of their own funds, but remember, a business want to flourish. If a business want to grow, then of course you need to go for a loan, because when you borrow funds at a particular rate where you can make a profit more than that loan interest that you offer, it's worthwhile taking a loan and doing a business, because the interest component what you make here for the loan, you will make a double or triple profit by making this import export transaction. So it's worthwhile go for a loan, rather than you dumping your capital and doing every business until you have a huge profit margin. So other than that, it's not worthwhile doing everything out of your own capital, because there is a cost to your capital also. You need to make sure uh, you go. So that is the reason in any trade, loans and the businesses are inseparable. Any businesses require loan for them to do their day-to-day activities. So trade also same. What is the conversion cycle? That is, when you buy goods, you sell it and it become cash. That is your working cycle. Cycle mean your working capital, right? So term loans are given for, you can see, LCs as well as documentary collection. So suppose say as an importer, when he gets the collection documents, DP or DA, there is no LC now. He will have only import facility. He doesn't deal with any letter of credit, but they start with letter of credit, now switch on to documentary collection, where the exporter is trusting the importer now. So the exporter sends the goods, but of course he is told, the importer, you have to, I will send you the documents again payments. So meaning he ship the goods, send the documents through the remitting bank. The remitting bank send the importer's bank collecting bank, and the collecting bank presenting the documents to the importer. Look here, the payment term is DP, documents against payment. So you need to collect the documents and make it the payment. But if it is a LC, the importer has to open the LC, he has to make arrangement, maybe his facility is blocked. So all that cumbersome. But when it comes to documentary collection, it's very convenient. But remember, for a seller to switch on to DP from LC, he should have a trust with this importer. Otherwise, it's a risk that exporter taking. Because when he get the LC open, he has been given assurance by the importer, no worries. The importer bank has said, no worries, you send the documents, we will pay you. But here, DP, there is no assurance as such. On his own, he send the goods to the importer. Right? Send the document through the bank. And his bank sends the document to the collecting bank. And the importer bank, the collecting bank. And the importer says, okay, come and collect the documents and pay. Documents against payment. So if the importer doesn't pay, what will happen? The goods will be lying here. This is the risk export has taken. Huge risk here, DP. So maybe DA, there's more risk. DA means what happened? Documents against, we learn both documents against payment and document against acceptance. Document against acceptance means here the exporter given more facility now. DP mean he will tell the bank, you release the documents against payment. DP, documents against payment. DA mean documents against acceptance. What is this? Here exporter says, release the document when he signs the bill of exchange. I have given a credit period. Now the importer has more facility under DA. He has a credit period of 90 days. So what happened? The collecting bank asked the importer sign the bill of exchange. So the bill of exchange is drawn on the importer, drawn by the exporter on the importer, prepared by the exporter, addressed to the importer, and asking the bank, collecting bank, when the importer signs, accept the bill of exchange, when the piece of, that is you call draft, when he places his signature, it's become a bill of exchange. Once the signature is placed on the draft only, it's become a bill of exchange, legally enforceable document. then what will happen? The importer is committed to make the payment on the bill of exchange, right? That is DA. So under documentary again collection or DP or DA, the import loans are granted. Generally, remember DA, there is no loan is required. Import loan is not required because he already got a credit period from the exporter. So it's mostly, when you say documentary collection, it is mostly for DP. DA is really, he's already got a benefit. Why should he want other facility from the banks? Generally, bank only grant it for DP. DA generally get a credit period, unless he get a credit period very short, 30 days. Then if he wants to make the payment, bank might make the payment and give him other 30 days or 60 days. That is very exceptionally, but documentary collections are also there. So this is to cover when the import documents has arrived. Now importer doesn't have funds. With the import loan, he will tell the bank, okay, you debit my loan account and settle the import bill. So the import bill will be settled. So if it is a DA bill, 30 days, he has to settle it. Then he will ask the bank to settle 30 days DA, and then the loan will be given for the 30 days or 90 days or whatever. Generally, banks give import loan up to 90 days. 3 months period, generally credit loans are granted up to 90 days. Short term. All import loans are short term, right? So here what happened? When the import loans are granted, there again it's the same way. There will be a limit established, right? But here, what you got to understand, there is something called trust receipt and pledge loan. There are two things here. When the importer has a limit, right? So that is the limit he marked, against which there are instances he will say, okay, I want a trust receipt. That means trust receipt is an agreement between the importer and his bank. Okay, we are going to give him a loan against the commodity, against the goods that he imported. So that kind of a facility called trust receipt. Sometimes bank might have a limit, still they sign the trust receipt to ensure the limit is marked, but you need to make the payment by signing a trust receipt agreement. Or you may call as a pledge loan. There are two things we are going to learn: trust receipt and pledge loan. Trust receipt is bank trusting the goods will be against the goods only they are given the finance. Say importer got the goods worth of $100,000, 100,000 Sri Lankan rupee. Let's say 1 million worth of goods he collected. Goods have come. The bank will make the payment on behalf of the importer. So they debit the import loan and clear the documents and given to the importer. Importer now clear the goods. He has to sell it and repay the loan. Until such time, the bank will ask him to sign a trust receipt loan. Trust receipt is an agreement. When he grant the loan, they are asked the importer to sign a trust receipt, because bank given that money, trusting that goods what he cleared will be sold and repay the bank loan. The limit is to cover the exposure in the event of default, but by routine working, bank try to get the trust receipt for each loan they granted. So that is what we are going to learn: trust receipt. So it's a legal document. When you are releasing goods to the import documents and granting a loan, you are allowing that loan to be used to purchase that goods, right? So the importer taken your money to clear the goods. So the bank has the right against the goods that have been cleared, because they only given the money to clear the goods. So the bank has the legal right over the goods. That is what trust receipt all about. So the bank has the legal right, ownership, but of course the goods are given to the importer to sell it and repay the loan. So under trust receipt, the importer will have to repay once the goods are sold and collect the money and repay settle the loan. So the trust relationship is it's kind of a promise. So is importer saying, okay, I have got a set of documents, I'm going to clear these goods, please pay me. So the bank will pay him under trust receipt. Then he will go and clear the goods, sell it, and to the distributor, sell it and recover the money and repay the loan. So until such time, the goods are trusted with the importer. That is, we call trust receipts, right? So importers point of view, he has the free flow funds by taking import loan. He doesn't utilize his working capital. Instead, he has taken the money from the bank. He doing the businesses from the bank's funds and repay the banks with a small whatever the interest, because he has agreed to pay certain amount of interest. So this facility may be uh, uh, better importer's point of view comparison to overdraft. Maybe it's lesser costly, right? But bank point of view, its working capital is good. Its bank point of view, it's bit risky because they trusted this guy and already has cleared the goods and gone. So its goods are totally out of control of the bank, trusting that he will make the payment. Of course, bank will cover by establishing some immovable property. Otherwise, bank can't trust each and everybody, and they can't go behind these people and make sure when they don't pay. So, but they will establish a limit. So they will have immovable property to as a security to cover that. But each and every loan import, when you're granting, you need to get a trust receipt signed so that you have legally right over the goods. So you need not to go to take your security, immobile property and all. It's high risk. I mean, it's a cumbersome for you to enforce the security and go to legal. It's time consuming. So it's better to get a trust receipt signed for each loan, though you have a limit, so that you will cover every time you have a right over the goods that have been cleared against the loan that you granted. So that is what the trust receipts are. So the bank should permit first. So very integrity. Yeah, you need to check the integrity of the customer, because trust receipts are generally you trust. The name suggests you need to have a trust with the importer. Otherwise, you don't give this facility. You simply a cashback facility only you grant, right? Then there is something called pledge loan. It's Sri Lanka very hardly used, but these facilities are there. Pledge loan mean here what happened are quite different here. The bank take the custody of the goods. Here, when the goods come, the importer want the finance. But what happened? The banks keeps the stocks with them. They clear a component of goods when he makes the payment, right? They, let's say 1 million worth of goods have come. So the importer says, okay, under pledge loan, give me 100,000 goods. So out of 1 million, 100,000 goods is released to the importer. He go and sell it and bring the cash to take the next lot. So though the pledge is practically is not very much convenient for the banker, because banker need to have the own warehouse. In Sri Lankan context, I think those days banks had the pledge loan facility. Now it's become more cumbersome. There is a administrative cost. It's very high costly affair. You need to deploy security, and you need to insure the goods that kept in your premises. So this is generally for hardwares and all. Bank uses the pledge facility, where these generally for movable goods. The goods are pledged against the loan facility, so that what will happen, the goods are kept under the custody of the bank. Whenever goods are released, the importer has to make the payment, and he sell it and make the payment and clear the goods. Make the payment and collect from the goods. The goods are under the custody. So the bank become a pledgee. Under this arrangement, bank become a pledgee. The lender become a pledgee. Pledger is the borrower. So the borrower need to repay. The goods are with the goods will be given to the borrower when he makes the entire payment. Until such time, the goods are with the pledgee. Possession of the goods, actual possession of the goods are take custody of the pledgee with the bank. In the case of a default, the bank has the right to claim the whatever and sell it and recover their losses. That is called pledge. So you know the trust receipt and pledge, there is a difference. Trust receipt is under the custody of goods are custody with the borrower. Pledge, goods are with the bank, and they have the legal right. They release the goods when he makes the payment. That is pledge loan. But in Sri Lankan context, pledge loans are very rarely in existence, because the cumbersome and the administrative cost involved. I think issuance of shipping guarantee we touched upon, but here it comes as a facility. Sometimes importer doesn't have import loan, but he opens LC under cash margin, under nil margin. Let's say he open LC under nil margin. Now goods have come, but here then he has to give the margin, because the moment shipping guarantee is issued, remember it is almost releasing the original goods to the importer. Shipping guarantees, I think we learned in the previous session, shipping guarantees are used in the absence of original bill of lading. So when the importer's consignment arrive, where the relevant documents have not come through the banking channel. Here, it's generally, shipping guarantees are generally involved with letter of credits only. The banks do not give any shipping guarantee for DPDA, right? Generally, bank do not give. Letter of credit, yes, there is, because bank only open the LC. the goods also will be consigned to the bank, right? So what happened when the bill of lading is not there, or bill of lading is not received by the importer or the importer's bank, the goods need to be cleared. The vessel has already arrived. So the bank comes in to issue a shipping guarantee. So if the LC is open under nil margin, at that stage when you are issuing a shipping guarantee, you must ensure the facility, either loan facility granted or the money is taken when you are releasing the shipping guarantee. So this is again a facility. If the LC is open under nil margin, either you grant import loan to release the shipping guarantee. So that is also kind of a facility given to the importer in the absence of the original bill of lading channel through the banking channel, right? That is also used. So as I told you, the importer need to ensure once the original documents come, he has to cancel the shipping guarantee. He has to follow it up and cancel. And even bank has to follow it up because it's a exposure in their books. It's kind of a contingent liability. You are given a responsibility. You are given a letter of indemnity to somebody. The shipping company can claim it later. So why do you want that contingent liability to be in your books? When the original bill of lading comes, you need to reverse the liability. You need to take off the liability from your books. So you will ask always the importer when the original BL comes. You will tell the importer, go and cancel the shipping guarantee and bring it back and giving it to us. We will cancel the shipping guarantee because the shipping guarantees are given in favor of the shipping company on behalf of the importer since the absence of the original bill of lading. So shipping company do not release the goods without the original BL. So the original BL is not here in this situation because the documents have not come to the bank, but the vessel arrived, or the ship arrived to importing country. So the importer has to clear the goods. Otherwise, he has to pay demurrage. So the demurrage is something I think I explained previous class. Demurrage is an additional charge that need to pay to the ports authority because they're moving the goods to the different location. So there is a cost involved. Goods need to be protected. So there is an additional cost. So the demurrage involved. So that will be to avoid the demurrage only. You want the shipping guarantee to be clear. It's kind of a facility, right? So these are facility given to the importer. Now we are moving on to the facility that is going to be granted to exporter, right? Before that, summarizing, when you are giving a facility to importer, right? Summarizing, if you are giving a facility to importer, right, you need to know. Now you know the facility, a letter of credit facility, import loan facility, or shipping guarantee, whatever facility you give for an importer. These facilities are, if it is a regular importer, is reviewed regularly. So these information maybe one-off case or maybe continuous. Generally continuous import custom means they will continue to do import. So you need to have this facility review. When you want to review, you need to have these documents, audited financial, you need to. So whenever you grant a facility, you have to follow up with the borrower to ensure the borrowing company is doing well. How do you know they are doing well? By looking at their financial, by looking at the audited financial, whether their net profit is growing over the previous year, they are growing, whether their balance sheet is good. The financial statement, audited financial statement will reveal that information. So that is the first-hand information. And their business plan, are they into expand? They are coming for enhancing their limit. So you need to have their business plan, whether they are going to enhance their businesses, their business plan should be given. Future forecast, whenever they expect whatever the cash flow come based on your future. Remember, a bank will only grant a loan when there is a cash flow generation. Any loan for that matter, including personal loan, whatever, you should have a cash flow generation. Why? When bank grant a loan, bank expecting the borrower to repay. Where is the repayment coming from? The cash flow generation. The cash flow generation should be either if you are a salaried person, your income is the only way cash flow, unless you have any additional income that may contribute as a cash flow inflow in the settlement of. But when it comes to businesses, there must be different flow, cash flow. They will generate income that need to be checked before they establish a limit or before they review the existing facility, right? Appropriate collateral. Collateral is a security. Collateral is security. So whenever bank offers some facility, there should be some security collateral. So this is where the limit is established. That is a buffer, right? Now when somebody mortgaging is out, why is mortgaging his house? The bank is not worried about the mortgage. No, bank is worried about his repayment. Mortgage is taken as a security, but bank granting a loan based on his income. Bank doesn't go on the property, right? So most of the people in banking, when you are saying you are working in a bank, some ordinary general people will come and ask, can I borrow a loan? I have a good house. This is the generally when you say, when you are working in a bank, when you talk to somebody general public, what is the first thing they will ask you generally? This is what I experience. I think most probably you will also. You would have by now, but you definitely come across people talking to you when you're working in a bank. Can I borrow? Or some people might say, I have a nice looking house. Can I borrow? So you must understand to answer this kind of a question. What is the basic requirement here? Bank is not buying an house. You have a good house. Okay. What is your repayment capacity? If you don't have any repayment capacity, there's no way you can borrow a loan. you you are going for a credit card. So what is first thing, what do they ask? What is your salary? What is your income? Because when you are utilizing the credit card, end of the month you need to repay the credit card amount, outstanding amount. So there should be the cash generation. So likewise, any businesses has to show the cash, forecasted cash flow. Then only the bank knows, okay, how this loan will be repaid. It is not the limit we are worried about. Limit is at the end of the day, if a default come, if the company become unable to repay, then only you will crystallize the security or the collateral. That will comes as the end, as a last resort. But you look at the cash flow because you need to make sure the current loans are paid out of the current forecasted income. That is the general perception when you are granting a loan, right? That is still applicable. You should have a contingency plan in the event of something happen. So in the event of COVID, your shop is closed. How are you going to operate it? That is called contingent plan. So you get a credit report about the borrower's standing, credibility, whether he defaulted, whether his names are cleared, some credit report on that. And the directors, bank always keep an eye on the directors, whether they are up to some mischievous activity they involved. So you need to keep on follow the company progress, company growth, because that is very important. Otherwise, the loan become a RPO and become a non-performing loan. Information surrounding the liability of the company, whether the company has borrowed anything, are into financial difficulties. So that is where you make sure that before you grant any facility, this is the forecasting of an import customer and the contribution they made. So when somebody borrowing loan, remember the bank has to ensure what is the contribution borrower putting it. Bank won't give the 100%. Even if you are buying a loan, you can see bank is giving only 75%. 25% you need to put. Why is that? Because if they give 100%, there could be misuse by the borrower. He knows he has not contributed anything. The more the borrower's contribution, the more the critical way the borrower looking at, because he has also input the money. If the asset is become bad, he also going to lose the money. So therefore, always when the bank is lending, they expect borrower also to contribute, so that the creditor bank also will contribute a proportion, not the entire 100%. Bank never grant anything for entire 100%, right? Remember, unless they have a limit and they will offer, they have a security to cover that. If that is not the case, bank will always 70 to 80% or 90% is the maximum bank can go, nothing more than or equal to 100%. Right, now we are moving on to the pre-shipment, and this is for exporters. Year in after we are going to talk about. Now the import is over, import part is over. Now year in after we are all facilities structured for exporter. Think of a Sri Lankan exporter, so you will better understand it. A Sri Lankan exporter, he has a garment order. We will go with the same basic. Take example, Mass. Okay, there is one of the leading exporters of garments, Mass Holding, right? So they need lot of finance from the bank, because they got lot of export order. They need money to manufacture that order. They need to import raw material, they need to do the value addition, then they make the finished good and export. So this process requires some money. So this kind of a facilities are export facilities. So there are two types. One is pre-shipment. Pre-shipment is you generally you call packing credit. Pre-shipment is kind of a packing credit facility. That means the word suggests packing credit means the bank giving funds exporter to arrange the goods. That is what you call packing credit. You for up to packing level you bring, so that we are giving a credit. That is called packing credit. Okay, so here what will happen, if you are exporter, you got a order, export order or letter of credit. You will get a letter of credit opened by the importer, or you got a confirm order by importer, then you are going to ship the goods, right? So you have an export order. to ship your exporter. You got a LC open by the importer, or you would have got a confirm order. He's going to buy this. Now you are going to send it on confirm order. That means not on LC, maybe on DP, confirm order. Right. Now you have a confirm order. You come to the bank and say, I got LC. Oh, I have a confirm order. I want to ship these goods. I want money. Then, since he got the order, he doesn't have working capital. So he's asking bank to support. So the bank will support about 70 to 80%. As I told you, see the percentage, 70 to 80% only bank will contribute. He has to contribute the balance, right? So what will happen? Bank will, if you have an export, take example, I'll give you one example so that based on that you will study. There is a USA buyer wants to buy a garments from Mass Holding for $100,000. $100,000. That is the order. Mass Holding received. Sri Lankan garment manufacturing company got a export order to ship shirts or garments worth of $100,000. Now Mass Holding coming to the bank and saying, we want finance from the bank because there's a working capital. We want to finance from the bank. So bank says, okay, what is the amount? 100,000. So bank will say, okay, we are giving $75,000, 75%. So we are giving you $75,000. So what will Mass Holding? They give the LC to the bank or give the confirm order to the bank, and the bank will grant a facility, packing credit facility up to $75,000. So bank will credit their account in rupees. So they will utilize that money. They will utilize that money to make import, make value addition. Entire 75,000 they will make use to arrange the export commodity. So they will, so you can see they will buy material, raw material, labor, supply, produce, package, everything ready to transport. The goods are up to ready transport level. They will make the money utilized. Now the export order is ready. What they will do? They ship the goods. When the money comes, when the export money comes 100,000, bank will recover 75,000, give the balance 25,000 to the exporter. That is we call pre-shipment guarantee. So here the bank is granting a loan before the exporter ship the goods. Pre means before the shipment. So here the facility is granted for the exporters to arrange the goods. That is what we call packing credit. The packing credit facilities are given to the exporter when he gets the order for him to arrange the goods ready for exports. So all the costs can be covered by the facility granted by the bank. So the exporter utilizes that money to keep the goods ready. So when he export the goods, when the money comes, bank will recover their proportion, whatever, $75,000, and they credit the balance to the exporter's account. So here what will happen? There are people, when they are having a confirm order, the bank might say, okay, that is not a good security. So here, look here, somebody says, I got a confirm order. That means he got a confirm order from a USA company to buy a shirt. It is not a LC, right? It is a confirm order. So somebody willing to buy. So based on that, if he come for a loan to the bank, the generally bank might say, if he's not a tested customer, bank might say, sorry, we won't be able to support you. It's high risk. Actually, it's high risk because there are two things. One is a performance, other one is a payment. Packing pre-shipment, there are two things. He has to perform. He has to utilize the money to keep the goods ready. Then when the goods are shipped, the money has to come from the importer. How do we know whether the importer will pay? There is no LC here. If it is LC, you know there is a commitment by the bank. It's a just export order. So in a situation like that, there is a local organization called SLESI, Sri Lanka Export Credit Insurance Corporation. They will give a guarantee to the bank, no worries. Because this establishment is a government establishment to support the exporter. They give a guarantee to the bank. No, we are guaranteeing this guy will do this order because their aim, their vision is to support the exporter, promote the exporters. So SLESIC will give a bank guarantee to the bank. Okay, you give a pre-shipment guarantee, we are covering you. Right? For that, there is a premium need to be paid. So the SLESIC, whenever SLESIC guarantee is taken by the exporter to get a bank facility, whatever that SLESIC charges need to be paid by the exporter because that's an additional cushion he get it from the SLESIC for him to get the bank loan done. So here, the SLESIC come as an intermediary between the export and the bank. So the bank is not willing to give a loan because it's an export order only. Bank at a high risk by taking that export order, like let's say 100,000, I have given as a bank, I have given to an exporter, but he's not making, he misused the entire money. So where is the bank going to recover this money? Right? So there is a performance, there is a payment, both are riskier. So here if the SLASIC give a guarantee, the bank is comfortable. Now bank granting a loan so that exporter utilizing the money, he will ship the goods, and when the funds comes, bank will recover. So the bank will have extra comfort by taking a guarantee from a SLASIC. That is the extra precautions. That is to cover that. So SLASIC is giving a guarantee for both pre-shipment and post-shipment. SLASIC is a government organization. The aim is to develop the export, support the export. So they will give a bank guarantee for them to take a pre-shipment guarantee. So this facility is called hypothecation. So when you are giving a packing credit, when you are giving an import loan, I told you it's a trust receipt. But when you are giving a packing credit, it's called hypothecation. This document is signed. Whenever there is a loan given, you get a loan signed by the hypothecation. This document is called hypothecation. You sign by the exporter. So exporter has to sign the document. So this is actually creating a charge over the money that you are given to the exporter. So every time, whenever there is an export order, you have LC, right? You have LC. Say there is a LC given by the exporter, you got a LC opened by the USA importer. Garments, there is a garments order. There's a USA buyer, open LC. Now the bank has got the LC. A bank is comfortable with LC, but there again, that is LC. It's the only trust he will make, but there should be way out to binding this person. So whenever packing credit loans are granted, hypothecation is the document the bank will ask the exporter to sign. Every loans that granted hypothecation need to be signed. So that hypothecation will allow the bank has the right to whatever money they grant, packing credit, that money is utilized to acquire certain commodities. So they will have a right to claim the entire thing in the event of a default. He's not repaying the packing credit loan. So the bank can go to his warehouse and take all the custody of the goods because the customer signing hypothecation. So by signing hypothecation, he gives a legal right. The bank has a legal ownership over the goods over there. Because every time, remember, when bank grants loans, bank might grant to the wrong party with a different intention. So if that person taking a right for a bank, then bank need to cover the exposure. That is the reason these documents are involved. Trust receipt, hypothecation. These are legally enforceable documents. So in the event of a default, if they willfully default, the bank need to cover themselves by getting this document signed. That is what in import loan, trust receipts are signed. In export packing credit, hypothecation is signed. So hypothecation is signed against the movable goods given to the where the exporter has purchased from the packing credit funds, right? So this is against the inventory. This is against the stocks that this exporter has purchased. So if the borrower default the loan, the lender has the right to seize the whatever possession they can take it over the goods. So that is the legal right always by getting a document. Trust receipt and hypothecation is the legal document. You will binding the importer and exporter so that when the bank as a facilitator, they will cover the exposure, right? The borrower don't have the right to sell. So they have to settle it. They can sell it. They have to sell. When they sell, they have to repay the loan. So without fulfilling the obligation, they can't sell it to somebody. So they have the right to sell it and recover the loan, settle the loan. So that is where hypothecation, right? Now post shipment. This is after shipment. Pre-shipment, before shipment. What is post-shipment? After shipment. So what type of post-shipment facility we are talking about here? Sometime what happened, as I told you, there are instances exporter given credit facility to the importer. I think we learn under LC, acceptance, deferred payment, there are credit period given. Even though it's under LC, the exporter has given a credit period to the importer. So what will happen? Though the exporter export the goods, he has to wait until the time period comes as maturity. Let's say exporter, a mass company take the same order, $100,000, they got it. But the buyer has told the mass, okay, I will give me 90 days period. I will pay you after 90 days period. So he wants 3 months. But he opens the LC. But it's 90 days LC, Usance LC. It's when you say side payment, I think we learned this word, side payment, negotiation, acceptance, deferred payment. I think acceptance, deferred payment, there is a credit period involved. That is what you call the usance period. Side means when you sign the document, it's immediate payment. Usance means there is a credit involved. There's a acceptance and deferred payment. So in acceptance, there's a bill of exchange involved. In deferred payment, there's no bill of exchange involved. Both are similar terms, but only difference is acceptance, there is a bill of exchange involved, right? Now, these two terms, the seller gives a credit period to the buyer. There is a credit period, remember. So, what happened? Why the post shipment is required? Now, you might wondering why do the exporter require once he ship the goods? No, what he shipped the goods, he has given the credit period. So, he has to wait until 3 months the importer to pay. Until such time, he doesn't have money. So, what he will do, he comes to the bank and say, look here, I shipped the goods. Now, I have the set of documents. Can you give me the money? That is what you call post-shipment loans. After shipment, the exporter has the set of good documents and he will come to the bank and ask the bank to negotiate and give the money. So the bank will purchase the documents. But if the documents are perfect in order, bank will advance the money. So provided this facility is only possible if the exporter give a full set of compliant set of documents. What do you mean by compliant set of documents? Now, when the LC is open, the exporter has to meet all the terms and conditions. So when he meets all the terms and conditions without any mistakes, without any discrepancies, it is called compliant set of documents. That means the set of documents are perfect so that the bank can immediately pay. So that is what you call compliant presentation, right? So here, once the exporter done the shipment, whereas he will only get the money because he already granted a credit period of 90 days to the importer. He has to wait until the 90 days. So here what happens, he shipped the goods, he has a valid set of documents, he goes to the bank, asking the bank to either discount or negotiate and wants the money. Right. Now the bank is going to do that. When the bank discounting the bill, they will be financing against the documents. So the under post shipment facility, it is granted once the exporter did the shipment and he has the documents, he come and sell the documents to the bank. If the documents are perfect, only bank will pay in advance, and bank will wait until the maturity to clear from the importer. So these are the two facility granted for pre and post for the exporter. So under post shipment, there are two: negotiation and discounting. As I told you, negotiation comes in when there is a LC. I told we learned this, right? And when there is a negotiation, mean there is always negotiation of documents. So under LC, the bank will give this facility only when the exporter submit a perfect set of documents. So the document should have been perfectly without any discrepancy. If the documents are perfect as per the LC, it is only under LC. Remember, no other terms. Negotiation is only under LC. So when the LC's terms are perfectly all right, when there's a credit period given, the bank will advance. So there is a caution. The exporter need to ensure he present a clean bill. Clean bill means without any mistakes, without any discrepancy. All the documents should be perfect. Then only we'll get the money under negotiation of export bills, right? So if the clean bill are negotiated and the exporter's accounts will be credited by the bank, and the sometime what will happen under acceptance, under acceptance, right? We learn these payment terms, I think negotiation, acceptance. What will happen when there is acceptance, there's a bill of exchange, right? So sometimes what the exporter bank does is, let's say there's an exporter, he got the LC opened by the importer, acceptance after 90 days. So what happened? Exporter send the documents, export the goods, and he will ask the bank, okay, I want this document to be sent under LC. Bank check the document, everything perfect. Document is sent to the importer. The importer bank will release the document asking the importer to sign the bill of exchange. Once they sign the bill of exchange, the importer bank now confirm the maturity date is so much. The bill of exchange is accepted. So under acceptance, when the bill of exchange is accepted, the issuing bank will confirm the date is so much. On such and such a date, the bill will mature. So the import bank is legally obliged to make the payment. When that date is confirmed by the import bank, now the export bank can give the money because they know there is a commitment by the import bank. Now the export bank do not have any risk. They will simply give once the acceptance is there, they will give the facility to the exporter. So that kind of a facility is generally low risk when it comes to acceptance negotiation is low risk than the bill discounting. So bill discounting is not under LC terms. So that is what next we are going to look under bill discounting. Discounting of export bill. Remember, discounting of export bill not under LC terms. Here the exporter has done the shipment on DP terms or DA terms. So discounting mean it has to be DP mean there is no credit facility required, because when he sends the document on collection on DP term, the documents will be released only payment. Also, the exporter will get the payment immediately. But it's a DA, documents again acceptance, where the exporter given a credit period. Now the exporter given the credit period to the importer will release the document again, acceptance, sign the bill of exchange, and they will send the document bill of exchange inform. Once the bill of exchange signed, the collecting bank will inform the remitting bank the bill is accepted and due for payment on such and such a day. Now the exporter comes and asking the bank, can you discount this bill? It's up to the bank. It's a very high risk. It's up to the bank to offer this facility against the collection bill. It is not backed by the LC. So you must understand, discounting is not backed by the LC. It is only for DA bills, document again acceptance bills. So not backed by the LC means it's high risk. So it's up to the bank to offer this facility based on the credential. So there should be something called, you are learning something with recourse. So what do you mean by recourse? Meaning when they discount it, they always discount with recourse. That means in the event of the importer not paying on the maturity, the bank will recover the funds from the exporter. That means bank saying we are giving you a facility with recourse. That means we can come back to you in the event importer doesn't make the payment on the due date. That is called with recourse. So always discounting is with recourse. So remember, what do you mean by with recourse in international trade? This you with recourse, without recourse. You learn interchangeable. These are used. So you must understand, when a lender give a facility to somebody and saying with recourse, that means lender says, I'm giving you this loan with recourse, meaning I can come back to you in the event of the default from the other party. When the bank lend the loan, say without recourse, bank says, okay, I don't have any, without recourse mean once a loan is given, if the borrower doesn't pay, as a bank, I can't go back to the exporter. The bank says when they grant the loan without recourse, that means they can't come back to the exporter. So in bill discounted is always with recourse, because you are trusting a third party. Whether the particular importer will make the payment on a DA bill is unknown. If it is a bank, yes, you don't have your high risk, there's low risk. But in discounting, it's very high risk. Therefore, it's generally 80 to 90% you discount, cover your margin. But it is they generally do it for the very tested customer. A bank do not discount bill for unknown people. Bank always do for unless they take a security to do that. So sometimes unknown people come and asking bank to finance, because remember, there's a gap here. What is the gap? You should understand why bank finance is required, because the exporter has given 90 days credit period under DA terms. The importer will pay after 90 days. So working capital is blocked. If one consignment is done for 100,000, he doesn't have any money to do the second order. He's simply asking the bank, can you buy these documents and give me, because you will get paid after 90 days. So until this 90 days, I want the money for him to start the second order. That is what you call discounting. So so when discounting comes, or when there's a negotiation come, remember there is a credit period offered by the exporter to the importer. So the importer will take time to repay as per the agreed terms, 90 days or 180 days or 60 days. Generally, 60 to 90 days is a time period. Generally, 90 days is the credit general period, right? So this is what discounting of export bill. So when the payment is received by the importer, so the bank will take their liability and give the balance value. If remaining value, they will credit the exporter's account. Let's say the bill is 100,000, they will discount it for only 80%. The balance 20% they are keeping. When they get the full value, they give the balance 20% or whatever balance they will pay. They won't discount the entire value. They discount it for 80 to 90% of the invoice value. If the value is 100,000, they will pay $80,000. Then keep the 20,000. When the full value come, they will take the interest, because bank also, remember, bank also finance for 3 months. So they take the interest. So when say discounting, there's an interest component involved. So you must understand bank is finance their own money and bank is getting out at 90 days. So the bank is out of funds for 3 months for which they will charge interest. That is what they charge 80 to 90% of the invoice value. They need to keep the 10% to cover their interest component, right? That is what they discount it for 80 to 90% because they want the interest to be recovered. That is discounting of export bill, right? There is a foreign currency loan. We will study all these foreign currency account in a different session, but there is something called BFC. I don't know whether you by now these accounts are business foreign currency account. Business foreign currency account intended for the people who are earning foreign exchange, either goods or services. Any goods or service exporter, when you are selling goods or service to non-resident, you are eligible to open a BFC account. When you are opening a BFC account, you are also permitted to borrow from the bank for any purpose in Sri Lanka or to make current transaction. Make current transaction mean to import your material, all that you can use this money. So under this facility, under BFCA, bank can grant a loan for the business foreign currency account holder who are the exporters of goods or services. Both parties are there, goods or services. These people are exporters of goods or services. They are earning foreign exchange. So they are entitled to maintain an account called business foreign currency account. And these people are permitted to borrow from the bank. Looking at their working capital cycle, everything the bank looked at, and they grant a loan. When they grant the loan, remember, under this last year, when they revised this regulation, they brought an account called business foreign currency loan account. There's a separate account open under the borrower's name and under which that account will be credited. So the account will be credited in the business foreign currency loan account. That funds could be utilized for its current transaction. If you are an exporter, if you are buying raw material, importing raw material and manufacturing garment factory, let's say, so you are going to the bank and say, I want a loan of $100,000. So the bank can go $100,000 loan and they will credit the BFC loan. They will create a loan account under your name and credit that money. You can use that money to import your material, raw material. 50,000 you import raw material. You procure other accessories you want to buy. So you can utilize that money to do all this. You're purchasing everything. So when you export, when the money comes, bank will recover the loan. So it's a kind of a loan facility banks are giving to the exporter to ensure they have been facilitated in the event they are running short of working capital, but they have the order, so the bank can grant a loan for under the BFCA loan account, right? So here the problem is when the loan will be designated in foreign currency, because the loan is granted, BFCA loan is granted in foreign currency, right? Suppose say there is a loan granted for 50,000 US dollars, say example. This $50,000 you have granted, this customer has taken a loan. Now he is trying to expecting certain inflow of money which is not coming. So as a result, the loan remain unpaid now because he expecting some inflow to come. He borrowed from you. He offered some services, and that services people are not paying him. So he doesn't have the way of recover. Let's say part of it is somehow other paid out of 50. Let's say he paid 30,000. There is a balance 20,000. He is unable to pay. Now there's no way that he can. There is an inflow of 20,000 can come to repay this loan. At that stage, central banks has given the permission as a last resort. A bank can convert that outstanding loan into rupee and recover. In the event if the BFC holder unable to get any inward remittances, inflow of foreign currency, since the loan is granted in foreign currency, it has to be settled all in foreign currency. If the bank granting a $50,000 loan, they will charge a foreign currency interest rate in dollar rate. Dollar rate is 4 to 5%, not the rupee rate. The interest rate is charged for dollar rate. So you are given a concession, provided you also repay the loan in foreign currency. But your repayment capacity is stopped. You don't have an inflow of dollars. Then how do you recover the loan? So the option is given to the banker at a last resort. Anything outstanding foreign currency where the BFC holder unable to repay this loan in foreign currency, the balance component, outstanding component can be converted into rupee, provided you take the necessary document to ensure this person doesn't have any inflow of foreign currency, earning capacity is lost. You need to take the document evidence, then you convert into rupee and recover your loan. That is, as a last resort, they are given this facility to the banker. That is about the foreign currency loan. There's something called external commercial borrowing. This is again, central bank has reintroduced this for the local company to borrow from foreign lenders. Only companies, remember. This is not an individual, it is not a sole proprietor, this is not a partnership. It has to be a limited liability company. It can be private or public quoted company. So the borrower has to be company. They can open an external commercial borrowing account if they are borrowing from a foreign lender. Say there is a mass holding company, they found a financier in Europe country. There is one of the European company want to lend to mass group. So that loan possible, the loan agreement, they will, both of them sign a loan agreement. Now foreign lender willing to, because what happened if you take some of the European country, the interest is negative. What do you mean by negative interest? The minus. So there, the certain country, if you take Norway, Sweden, Switzerland, their interest rate, including Japan, the interest rate is negative. Negative means if you keep the funds with the bank, you don't get any interest. Instead, you need to pay the bank because it is interest rate is minus, negative, right? So in a country where the interest rate is negative, you can't keep the balance, balance in the bank. You need to pay for the bank because the interest rate is minus. So here, if you take, we are positive. When you keep them funds in the bank, they are paying interest because interest, we have a 2 to 3% they are paying. We are positive. The interest rate is positive regime. But there are certain countries in Europe, their interest rate is negative. That means you need to make sure you can't keep the balances in the bank. They don't pay interest. Instead, they are going to charge you. Right? So in a countries like that, it's always, as an exporter, it's better to tap those market and borrow funds from them. And there's opportunity now. So now export company wants of money from a European company or European individual. It can be individual or company. Lender can be anybody, but the borrower has to be a company. So you can open external commercial borrowing account in the bank and you borrow from a foreign lender. The lender can be individual, lender can be entity, lender can be any funds or cooperative institution in overseas. They can lend it to you. The money can come to external commercial borrowing. You can open with the bank and you can utilize that money for your export purposes. So this is one way of borrowing. This is not the local bank lending you. It is your own capability. You are directly borrowing from a foreign lender. So it is your own credential. It is not the bank's involved. Bank only facilitating by opening this account and getting that money coming in and giving it to you. So this is simply CBSL has given the permission. Okay. So what actually happen is when a foreign person making investment into Sri Lanka, it has to come in a designated account called inward investment account, IIA account. So let's say a foreign lender want to send the money to Sri Lanka, given a loan to the, giving loan also kind of a way of avenue of investment. It's also one of the investment avenue to lending it to a local company. So remember, a local, borrower has to be a local company. They can borrow from a foreign lender. That lender has to open IIA account and send the money. But lender doesn't like to open IIA account. So that is the reason central bank has given permission. Okay, let the lender send the directly money to external commercial borrowing account. So lender now asking his bank to send the money directly to the external commercial borrowing account of the borrower in a bank. The money comes in. That money will be utilized to make an investment or you utilize it for your business purposes, right? So what happened? The external commercial borrowing, there can be dollar comes in. Let's say the external commercial borrowing can open for a local company, which is export firm. They borrow from a foreign lender. So the bank will open external commercial borrowing in the name of the borrower, which is the export company. 100,000 euro has come. The borrowing account, external commercial borrowing account will have a credit balance of 100,000 in the name of the borrower. Now, borrower can utilize the money for its local purchases, everything. But if he doesn't want, when he want to repay, he has to again repay the 100,000 euro. But if he doesn't want to take the exchange risk, what he will tell the bank, keep that 100,000 in a fixed deposit account. The external commercial borrowing can be kept as a FD with the bank in euro currency, and against you grant a rupee facility, so that the borrower will not subject to exchange rate fluctuation, because he simply get the external commercial borrowing open in the name of in the euro currency as a fixed deposit, against which is borrowing. So that rupee facility is granted against the euro deposit. So that is the one as a bank, to mitigate the risk as a lender, you can ask the bank to keep at a FD, fixed deposit and external commercial borrowing in the euro currency, against which you can borrow rupee, so that you are not subject to exchange rate fluctuation. That is all about external commercial borrowing. Now we are going to learn invoice factoring, right? So I feel there should be break given at this moment of time. So we have almost 2 hours we covered. So we will have a break of 15 minutes. Sharp 3:45 we will meet you, right? So have a break and we will meet you around 3:45, right? Okay. Uh, so now we are moving on to invoice factoring. This is again supporting an exporter. Uh, there are financial intermediary, there are financial organization which involve as independent. They are into these factoring businesses like merchant banks, even some of the commercial bank also doing this invoice factoring, or there are independent financial institution doing this invoice factoring. Meaning, uh, let's assume there is an exporter who has given receivables. That means he was given a DA shipments. He has effected a lot of DA shipment. All that money is receivable from the debtors. So in other words, the import has to pay him. So what he does is go and do a factoring with a company. It's a bulk. Factory is generally done with a bulk. The bulk of invoices. Let's say he has about 10 invoices outstanding from various importers, right? So what he does is he go to the factoring company and giving all these invoices and get his money up front, right? So here the factoring the factoring or the bank who does that as comes as a financial. So they are the people going to give the funds to the exporter, whereas these bills are payable at a future date. So in other words, it's kind of a advancing money until they get the money from the real data, real importer. So here again, meeting a gap. So this kind of a facility is called factoring. Factoring is where factoring financier will acquire all the invoice receivable, all the outstanding payment which are due to the exporter from the importer. All those payment they will, in all those invoices, they will finance the invoices. That facility financing again invoices is called factoring. It's generally done with or without recourse. So it means, say, when they purchase with recourse, when they do the factoring with recourse, mean that company will go back to the will go back to the exporter with the recourse, mean with recourse, mean in the event importer default. Without recourse mean they have to somehow other sort it with the importer. They can't go back to the exporter. So you have with recourse, without recourse, always interchangeably used. So you should understand factoring can be come without recourse or with recourse. So if the factoring company says we can only doing all those advances against the payable with recourse, means they are saying, okay, we take the risk, we take the calculated risk, but with the recourse. That means if the importer doesn't pay on due date, you need to, we will recover from you. So they are going back to the exporter with recourse. Without recourse means they can't go back to the exporter. So either way it operates. Factoring company also knows if the importer is one of the reputed company, and they might go even without recourse. They might charge little more without recourse because they are taking the responsibility to recover from the importer without recourse. With recourse mean they are still advancing. With recourse mean they can go back to exporter in the event of importer doesn't make the payment on the maturity date. So that facility is there for the financier to go back to the exporter if they factoring with recourse. Without recourse mean they can't go back to the exporter. They have to cover the whatever due to them directly from the importer. They should have the capabilities to recover from the importer. If that kind of capabilities are available with the financer, they might do it without recourse. They might charge you also more because they have more obligation to recover from the import. If the import firms are reputed firms, these are generally bigger reputed firms. There's hardly any default going to happen. So they will finance if it is a reputed without recourse, right? So this is how the it can be used for domestic as well as inter. So the factoring can be done in local trade as well as international trade. So a lot of countries locally also you can do. So the factoring invoices are done for the local trade also. If you are a local company, you are giving it to the various creditors on a credit terms for 90 days, and you are out of money until you collect each debtor after 90 days period. Instead, you can go to the factoring company or the independent financial organization who offer factoring services. This has become more popular now. It is way of getting involved and recovering money with a fee. You get a substantial fee by doing this because you are simply advancing the exporter or advancing the creditor. If it is a local credit, you may call it as a creditor. So you promise, you make the payment to the creditor and get an obligation. You recover it from the debtor. So if it is a local trade, if it is a international trade, then you will tell the exporter, okay, I will factoring you all the invoices. It is subject to with recourse or without recourse, and you will have the obligation to recover it from the importer. So it is either way operated domestically or internationally invoice factoring, right? Then what is this? What is this? Forfeiting. What is forfeiting? It's a financial option exporter used to receive the immediate cash, especially for capital goods. So all that financing, what we have seen is the factoring done for the general commercial commodity. The forfeiting comes, or forfeiting, you may call it as a forfeiting. The pronunciation is forfeiting is the correct pronunciation. Forfeiting, huh? Forfeiting. Forfeiting is a financial option where under this is generally used for medium and long-term facilities, forfeiting, for capital goods, right? So especially for capital goods, forfeiting is used, right? Here, what happened is a medium and long term. You can see that terminology differs. There's a short term maturity. Here, forfeiting is long term or medium term. So the forfeiter is a person who discount, right? Here, the invoices are larger value. Here, the forfeit company is in this operation. Remember, it is no domestical. It is only international. It is only international, and also it is done without recourse. That means if a exporter doing a capital goods machinery or whatever capital good they export, they have a large value outstanding. So they will ask this financier or forfeiting company, you forfeit my invoices, you have to recover from the ultimate importer. You can't come back to me. So the forfeiting is always done without recourse. So forfeiting always without recourse. Factoring with recourse or without, but forfeiting is always without recourse. It is only used for international trade, especially for capital goods, not the ordinary commodities. This is generally for. So this is a bit of a typically different from the factoring, forfeiting. There is a secondary market. So there is a liquidity. That means these are reputed firms. Remember, when you are exporting machineries, the importing machinery is also reputed companies. So what happens when an exporter having a substantial outstanding invoice? So there again, remember, this is again financing a gap. Here the exporter have the financial, he has outstanding invoices for which he has exported capital goods. Outstandings are maybe 200,000, 300,000, 400,000, large value because these are capital in nature goods. The tenor also maybe 2 to 3 years. In Sri Lanka only you need to bring the machinery 1 year, but different country will have a different law. So you might have 3 years to repay, 4 years to repay. There will be exporters who will have the outstanding invoices for 3-4 years. Then they will go to these companies and they will ask them companies. So these company themselves go and approach people because there is a secondary market. So whatever the person who buys, they can sell it to the secondary market. So that is what the forfeiting is more popular. Where is say for example, what do you mean by secondary market? Mean, let's say a forfeiting company acquiring large invoices from some Italian machineries exporter. Italian machineries exported tile machines, all expensive machine, 1 million, 2 million. These are generally larger value ticket size, so maybe 2 million, 1 million, 500,000, right? Large value. So what happened when the invoices are 1 million, 2 million? This forfeiting company, what they will do, they will ask the exporter, okay, you give us, we will take the exposure, we will recover it from the importer after the maturity date, we will give you this value. That is the face value. This is one by one of transaction. Each there is no, but factoring is a combination of you take all the receivable together. But here, one by one transaction, because tickets are larger tickets, right? The high value capital. So you do one by one, whatever the outstanding exporter bill have the outstanding invoices, you go and negotiate with this forfeiter and asking them to give you the money in advance, that you no recourse, they can't come back, they have to recover it from the importer. So these companies have a highly connected network, they have all the importers, they know their credential, they know. Remember, when the people coming into this kind of forfeiting and factoring, they have to study the market, and they know each people and their capabilities and their credibility. They don't go and take keep their finger under the fire by taking unnecessary risk here. They know the market. They know who are the people they are going to take these tickets, because they know these are imported companies, are well reputed company. They will take the calculated risk here. They know the reputed company will not going to default, unless otherwise there is an underlying transaction, there is an issue. If not, so there again, they are taking without recourse. That means if any issue comes, they have to make sure. So they make sure these risks are, when they say without, always remember there are instruments which give them a comforts, bill of exchange, bank accepted use and sell. See, you can see they are, when they are going without recourse, they should cover themselves. Therefore, they are getting this all legal obligation document. Bill of exchange is already signed by the importer. The importer, they can legally sue the importer if he doesn't make the payment. Now, say for example, there is a bill of exchange signed for the machinery import by the importer. He has signed the bill of exchange, making the payment after 2 years. The bill of exchange is signed by the import company by placing the rubber stamp in the bill of exchange. So that is a legal document. Even the forfeiture company can sue the importing company after 2 years if they don't make the payment. So you could see this kind of facilities are done when the legal documents involved by nature of bill of exchange, promissory notes, bank accepted draft. When the bank signs the draft, bank is obliged to pay. So they cover themselves by binding these organizations. That is the reason they are going without recourse. So they need not worry about the exporter. They will leave the exporter out of the scene. They will take the responsibility. They know by whose responsibility they are taking. These are reputed firms, reputed banks who have undertaken to pay at the maturity. So they will make sure they recover it from these reputed organizations. That is the reason this kind of facilities are more popular, because what happened, there is a secondary market available. Why? Whoever people taking the risk, suppose a company A, forfeiting company, taken the invoice of 1 million, 1 euro, 1 million euro. There are 5 invoices, each 1 million. There are 5 million worth of forfeiting invoices they have done. 5 million. One customer and 1 million invoices into 5. So they have done this forfeiting for 5 million. So what happened when they're giving it to the other company lesser value, because it's kind of a discounting, because you don't get the face value, you will only get the face value at the maturity. So the people who are exchanging between them, they have to exchange it with a lesser value. So the difference between the discounted value and the face value is the profit they make in this business, right? So suppose say the face value of the invoices 1 million into 5 invoices, which is 5 million. But when the forfeiting company, when they take it, they will take it for less amount. They don't pay 5 million. They will pay about $500,000 less discounting period. 4.7 or maybe 250,000 or 100, let's say 150,000 less, 4,850,000 they will pay. When they want to sell it to a secondary market, there is somebody willing to buy maybe 4 million. You bought it for 4,850,000. Somebody willing to buy at little higher. So you sell it to somebody. That somebody is the last person to wait until to get the proceeds from the real importer at the maturity. So there is a secondary market also available. There is, therefore the liquidity is always, liquidity is there whenever whoever doing this forfeiting, they have the secondary market. So forfeiting also one of the popular way not in Sri Lankan context, we don't much of a capital goods here. Our exporter do not do that, but this is in mostly developed countries. Forfeiting is very popular. So here factoring, Sri Lankan now factoring because we have certain receivables domestically as well as internationally. Forfeiting is international product, very rarely used in Sri Lankan context, right? Okay, this is the entity we were talking about, SLASIC, who gives the pre-shipment, post-shipment guarantee, right? So the Sri Lankan Insurance Corporation also is a facilitator. So when you are doing financing trade, one of the organization you can't miss it is SLASIC, because they support in so in so many ways to support the exporter. This is their specifically Sri Lankan export. You can see the word export. So they focus only the exporters because they want any country is always promote the export because that is the foreign exchange earners. Foreign exchange earning is coming from export only. So everybody support for the export. So we also having a separate organization, government organization by the name of SLASIC, Sri Lanka Export Credit Insurance Corporation. SLASIC abbreviation is Sri Lanka Export Credit Insurance Corporation, which is the government body which supports exporters in a number of ways. Uh, they are giving protection against delayed payment. So when you are doing a pre-shipment, post-shipment facility, there could be importer can delay the payment. So there can be non-payment also. There is a default payment, non-receipt of payment, or insolvency. The company become a bankrupt, non-acceptance. That is repudiation of contract. Repudiation means delay, or you're trying to cancel the contract, right? So you deny the contract is not in existence. That is called repudiation. Repudiation of contract also they pay non-acceptance, right? Provision protection the exporters against political country risk, such as occurrence of hostilities, fight between conflict between countries, wars, insurrection. Insurrection is something, a violent uprising against the government is called insurrection. So when people starting violating against government action, that kind of environment prevail in a country, you call insurrection, right? That is insurrection. That is where is a violent uh, uplifting or increasing against the government is called insurrection. Political disturbance where there are a lot of issues happening. I think some of the issues you can see, right? Political instability in some of the countries, close countries like Afghanistan, Pakistan. Okay, these violences and this insurrection, fighting, terrorists, all these were we can see in the neighboring country happening. Uh, but there are natural disaster of the bias country. These are the risks that the SLASIC covers. These are totally unexpected risks they cover. So if you are exporter, if you are exporting to various countries, if the bias country unable to pay due to one of these reasons, they will take the risk of recovering this money from the importer. So as an exporter, you have a comfort by taking a SLASIC guarantee. You have been relieved not to worry about these things. So they will take care of. That is what in brief they are saying. Don't worry about this. We will take. So they will cover selected coverage of 60 to 90% insurance they cover. I think they buy. This is a credit insurance corporation, so they will cover your exposure by 60 to 90%. If in the event if say we exported something to Pakistan, there is a insurrection, it become a war conflict between other neighbor country between Pakistan and India or something happened, then as a exporter, the importer has to settle from Pakistan importer. So the SLASIC take over, okay, no worries, we will take it at a government level to recover from the, because they have that access to approach Pakistan at a diplomatic level, because this is a government organization. So they have the flexibility to have access to these countries at a high level so that they can cover this. These are for them it's uh, not a very difficult task. So that is the reason they are offering. But if you are an individual exporter, you won't be able to take a call to go back and find out the Pakistan person taking a legal action against him. These are you can't think of, because you are wasting a lot of time as well as money, and you will lose your business's opportunity also. So these all you give it at a one shot, you give in to them and they will take care of, right? That is the SLASIC. Yeah, bank providing working capital, because when the SLASIC guarantees are there, whether pre-shipment or post-shipment, these guarantees are supportive for the bank to giving pre-shipment and post-shipment guarantees. So in other words, simply what you understand here, if you're an exporter, if you go for a pre-shipment guarantee or post-shipment guarantee from a bank, what do you mean by pre-shipment facility or post-shipment facility? You have got export order, you are going to the bank asking the bank to give a pre-shipment before the shipment a facility. So what is the risk there? If the importer might not pay, or as an exporter, you are not paying, you are not doing your performance. So that is the risk. So SLASIC give the guarantee, don't worry. You give the pre-shipment guarantee, we are guaranteeing because this is a registered exporter, he will does the export. So then there again, other issue, when you do the pre-shipment, he has to ship and the importer has to make the payment. If there's a payment delay, also the SLASIC covers. So you need not to, as a bank, when you give a pre-shipment or post-shipment, after shipment, recovering money from the importer, any issue comes, SLASIC guarantee. That is the comfort you have by when you are extending pre-shipment or post-shipment guarantee. If you feel any risk there, you ask the customer to take a SLASIC guarantee. So the SLASIC guarantees are structured or tailor-made for a direct importer to obtain pre-shipment and post-shipment guarantee, pre-shipment facility and post-shipment facility from the bank. It's a facility, remember. Pre-shipment and post-shipment facility from the bank, they can easily take by getting the SLASIC guarantee. So SLASIC giving a guarantee to the bank, giving extend the post-shipment facility or pre-shipment facility to the exporter, we will cover you. So the coverage is 60 to 90%. So you need not to worry. The premium need to be paid by the exporter, because the exporters risk only the bank stake. So the export has to pay the premium for the insurance policies, right? That is the revenue SLASIC company generate by offering these products, right? This is the logo of SLASIC. Right. We are coming to the bill levelization. So what is this bill levelization? This is not very properly known. I mean, it is not popularly a well-known product. It's some people even not even knowing there is a product available like this. This is exceptional cases only bill levelization take place, where I'll give you an example. Let's say bill levelization is something like this. The Sri Lankan exporter done exports, right? There is a tea export to UK, right? On a DA terms. Now, he insisting is export, he has done export tea. There is a bill of exchange. He has given 90 days credit period to the ultimate buyer in UK. It's a tea commodity, 100,000 worth of tea has gone. Now, this is approaching the exporter, ship the goods 100,000, he get the money after 3 months. There is a DA, bill of exchange is signed. Now, you are approaching your bank. Can you do the evaluation? Can you do this evaluation facility? So the in other words, as a exporting country, you can't do the evaluation because this bill of exchange is signed, is in the importer's country, right? It is in the importer's country, they need to pay. Now that importer's country bank might take there's a drawee, there's an importer who has accepted the bill of exchange, right? They are guaranteeing, okay, in the event if the importer doesn't pay, we will pay you. Who is that importer? The drawee is the importer, and the drawee is accept the bill of exchange. Now that bank says, okay, we are taking a bill levelization facility because we know this drawee is a reputed company. So that particular drawee bank, there is an importer in Italy, in UK. Let's say Barclays Bank. Barclays Bank will do the bill levelization by adding whatever accepted draft, they endorse it, okay, this will be paid. So when that assurance is given there, the local bank might pay you in advance. So that kind of a facility is called bill levelization. So it's very rarely used here, But in certain country, bill levelization is used. That is because the bank who takes the exposure should be well known about the drawing. So if a bigger companies like international reputed companies like Google or Apple or Samsung, right? So these reputed company bill accepted on a deferred payment or on acceptance of 90 days, 108. These are reputed companies, corporates, right? So their bill of exchange can be availized by their banker because they know at maturity they will somehow the pay. So the bank on top of the acceptance, bank will uh, placing their signature or they will vouch it. They are taking undertaking against it. So with that, they offer a facility. This facility is called bill levelization. So in other words, bill levelization is where uh, a financial bill levelization is where the financial institution is generally a bank uh, adding their responsibility to accept a draft by placing an endorsement that drawee, if the drawee doesn't pay, we will pay. That is called bill levelization. If that facility is there, there is any local bank can pay you if the bill levelization. So the bank who does the adding the bill levelization definitely will charge because they are taking additional responsibility recovering from the importer, and they assure they will it will be paid at the maturity because they know the drawee is a undoubtedly a tested customer. So in an event like that, the bill levelization is workable. So the exporter may need the third party, generally a bank, to guarantee the bill of exchange payment drawn on an importer. So the exporter wants the money, where if the evaluation is done on the bill of exchange, then the bank who can easily pay because the bill is evaluated by a bank. So once the importer bank is levelized, the exporter bank will immediately finance because they know instead of the individual, they are trusting the bank because if the importer doesn't pay, the levelized bank will pay. Therefore, it's easy financing for a export banks once the bill is levelized by the importer's bank or or, or the drawee. Drawee is the import. In the event of a default drawee, the importer, the levelized bank will pay. So that is the Yes. So this is kind of a facility generally not used here, very rarely used. But in international term, these facilities are more commonly unknown. The people also will have a misperception. So to summarize again, for you to better understanding, what is this bill levelization in a acceptance DA document, set of DA documents? Classic example: take a DA document when there is a bill of exchange accepted, the bill of exchange accepted by the drawee. The importer will say, I will pay the exporter after 90 days. He signed the bill of exchange. That is accepted, right? If the bill of exchange, the drawee, the importer is a reputed firm, his bank, the drawee, where the importer's bank will make a endorsement in the bill of exchange and they will assure they will pay in the event of drawee doesn't pay. That is called bill levelization. A bank making an endorsement on an accepted bill of exchange in the event drawee doesn't pay at the maturity that they will pay. That is called bill levelization, right? So that is also product where they supporting the, again you can see bridging the gap, everything bridging the gap. That is called trade finance. The trade is finance when there is a gap, trade finance comes in. So that is the bottom line, is bridging the gap is always remember, that's easy to remember. Anywhere you see there's a gap, the bank is coming in to bridge the gap. Bridge the gap mean to finance that interim time. That is what called trade finance all about, right? In simple terms. Okay, now we are moving on to the bank guarantee. What is this bank guarantee? Okay, so bank guarantees any sign undertaking, however named or described, providing for payment presentation of a complying demand. Okay, so in international trade, remember in financing, the bank guarantee is one of the key, one of the significant instrument to deal with, because we are all looking at the commodities. Now all this facility we are talking about commodities. Now we are looking at the capital transaction. There's a projects. These bank guarantees are generally used for a capital transaction or service contracts, right? Now think of think of Sri Lanka giving a lot of infrastructure project to various people, right? How do Sri Lanka expect that contractor doing this project at the end of the period a solid job? Now we are given highways, the 4-year, 5-year, longer term projects. These are medium and longer term projects. So all that transactions are capital in nature, also bigger capital expenditure. These are high value transactions, right? Building an airport, seaport, right? And terminals, highways, railways, airport, bridges. These all capital expenditure, right? Upgrading electric line, water line, telecom line, all that is a larger projects. So when there are larger projects, to facilitate between these two parties, now there's a contractor in overseas and they are doing a project for Sri Lanka. The Sri Lankan government is the employer. So they are deploying this particular company or the organization to do a project in Sri Lanka. So what is the involvement of bank guarantee comes in to ensure this particular contractor delivering a solid job, right? The bank guarantee comes in. So most of the people do not aware uh, how these infrastructure projects that have been taking place. Actually, about if you take about 50 years ago, before 70s, most of the Middle Eastern countries, when they got lot of funds, when they found the oils are there, when they start exporting oil to various countries, they got a lot of funds coming in, huge capital, huge foreign exchange flown into their countries. They started giving a lot of project to various people, especially Dubai, UAE, Saudi. They given the various project to various companies to infrastructure because those are not that developed country at that time. About 50 years ago, they have not developed. So now, if you take Dubai now, it's a different, altogether different territory. It's a tourist attraction. So they have come all the way about 60 years. Before 60 years, it's just a desert, right? So when they started, the oil was found when they exporting oil to various countries, crude oil, they're getting money, foreign exchange. Then they started giving various people to prepare infrastructure project like put the road, highway, put the railway, put the airport, all that airports, all, everything, roadway, airway, hospital, building, every contract to given to various people. So what happened during that time? It was realized most of the contractor undertaken all these projects not given a solid job, not given a solid job. They taken the money and given a inferior services or not not up to the expected level. They are vanished. So they lost lot of money. Then they realized how to bind this the party between this contractor and the employer to deliver a solid job as expected. Then they realize the bank guarantee the ideal instrument to tie up these two people to ensure one party delivering what is promised to the other party. So that is where a sign undertaking coming in. However named or described, you may give a different name. You may call it as a performance guarantee. You may call it as an advance payment guarantee. You may call it as a bid bond, bid guarantee, tender guarantee, retention guarantee. You name any guarantee, right? However named, it's a sign undertaking. However named or described, providing for a payment on presentation of a compliant demand. There will be payment made to the person who's losing money. There will be payment made to the losser or the whoever the losing the contract or whoever losing the finance will be paid by the bank. That is a written undertaking, so that the employer or the person who's giving the contract to other person are now comfortable because he has been assured by a bank guarantee. So this is where the bank guarantees important were realized about 50, mostly after 70, 75. It was it was used in but Middle Eastern part. They were not aware the guarantees is a more valuable instrument to overcome all these issues, right? That is what the so the bank guarantee is kind of a sign undertaking by a bank to a party on behalf of a customer, assuring the beneficiary to effect a payment on a default of obligation. Right. So, like ICC publication, we learn so many things. We learn UCP, we learn URR, we learn URC, we learn Incoterms, right? All this is ICC publication. The ICC same publication issue set of rules for demand guarantee also. How do you call that? Uniform Rules for Demand Guarantee, URDG. That is the version is 758. I think that came into effect on the 1st of July 2010. It was 458 before 1st of July was in existence. The rules were upgraded and issued a new set of rules in 1st of July 2010, almost now 11 years, almost 11 years gone, right? The rule is still in existence. Very comprehensive 758 rules, which is very precisely described who are the parties, what is the obligation, what is the terminology, very clear. So the 758 is good set of obligation, good set of rules, which is practiced by parties involved in a guarantee. So there are different parties involved in guarantees. Like in letter of credit, we learn issuing bank, applicant, beneficiary. Same way, in a bank guarantee also, there are different parties involved, right? So do you know there is a beneficiary who is get the guarantee in favor? So that become a beneficiary. In LC, when you get a LC issued favoring of somebody, that somebody will be the beneficiary. So the beneficiary of the LC is the exporter. The applicant of the LC is the importer. Same way in a bank guarantee, the person who is the employer who is giving a contract to somebody has to get the guarantee. Because he is the one going to lose the money in the event something the contractor not giving as promised. So the loser will be the employer. So the employer will be the beneficiary of the guarantee. So in guarantee, the employer become a beneficiary, the applicant is become the contractor or the supplier. So the contractor or supplier is become the uh, applicant of the guarantee, and the beneficiary is could be the company who employ, right? So there are different, sometimes different transaction might give different terminology. You should know who is the beneficiary, who is the applicant. So let us see some URDG articles. I just take an article for you to better understand this, right? Uniform rules for demand guarantees, right? So Article 1 says apply to any demand guarantee. So remember demand guarantee. Why do you say demand guarantee? Remember the guarantees, there can't be any condition in the guarantee. It is a demand guarantee. Why do you call that demand guarantee? If the guarantee is given to somebody, if that somebody feels there's a financial loss due to somebody's uh, disobeying the obligation, that party can claim it without any conditions. Immediately they can claim it. That is what you call demand guarantee. The guarantee can be claimed by the beneficiary at any time when he proves that there is a financial loss incurred by him. So it's become demand guarantee. Anytime the guarantee can be claimed, right? So that is the reason you call that as a demand guarantee. So a demand guarantee. We are going to learn what is counter guarantee. I will explain to you what is counter guarantee. That expressly indicate it is subject to them. So this when it comes to this, remember this URDG, Uniform Rules for Demand Guarantee, UCP, all that is not law. Remember, these are rules. These are uniform rules. So these could be applicable to the parties involved in guarantees, can use this rule as a guide. So whenever there is a dispute among the parties, this article will applicable. If they incorporate in their guarantee, this is subject to 758. So when they say in the guarantee, this is incorporated subject to, then all these rule will applicable. So eventually, people who don't understand this terminology, they always prefer all their guarantees are subject to URDG. So when you make it subject to URDG, any dispute comes, you don't need to worry about. According to the article, you have the answers. Who has done the, who has to do this fair, who has to do this, who has to done this, who is responsible, all that is given, are specifically given. So that whenever you issue guarantee, make it subject to URDG. So that is what it says. Where at the request of the counter guarantor, demand guarantee issued subject to URDG, counter guarantee shall also be subject to URDG. So whatever guarantee you make, ensure when you are issuing a guarantee, always incorporate it is subject to URDG, right? So then it become a subject to URDG. That is what article first say. Application of the URDG. Always apply when you're issuing a guarantee, apply the URDG so that you don't. So you can even exceptionally say URDG not applicable. You can easily say that also, because this is not a law. This is just a rule. So if you feel this rule should not applicable, you have expressly indicated in the guarantee this is not subject to URD. You can say that, provided the other party agree for that. So everybody has to agree, right? So you can't on your own say it is not subject to because you feel URDG by incorporating URDG, you are at a bad position. But other party thinks other way. So he will insist URDG. Then you have to compromise. You have to say URDG because URDG is a common rule. It is not taken anybody's side. It is a neutral rules which all parties has to obey their obligation. If they meet their obligation, well and good. That's all. So it's always advisable URDG applicable in every guarantees issued, right? The definition of Article 2 given the definition. Applicant means this is the guy. This is the guy who has to have the commitment to give the guarantee to other person. Applicant means party indicated in the guarantee having its obligation. This is the guy who has to deliver. He is the applicant. Obligation under the underlying relationship supported by the guarantee. So he is the guy to meet the obligation. So in the guarantee, this guy become applicant. So the applicant means the guy who has to make the commitment to the other party. So applicant is the guy has the obligation to deliver. So in other words, he is the contractor. He could be a contractor, he could be the supplier, right? Different name, you can use it. Underlying relationship means they are given a definition for each word. Applicant is what? Underlying relationship means there is a contract between two parties. Now, underlying contract is where when there are two parties, they have an underlying relationship. Now, see, there is a buyer-seller, they sign a contract, right? When they sign a contract, that is the underlying relationship. Under that contract, they do a transaction. But guarantee comes as a secondary. Guarantee is not subject to the underlying transaction. Guarantee just to make sure if the underlying transaction is disobeyed by the one party, as a result, the other party suffers. Under the guarantee, he can claim it. So the guarantee comes as a secondary. The primary is underlying transaction. So underlying transaction has to take place smoothly. In the event something happen underlying transaction, as a result, somebody is financially suffering, that party can claim it under the guarantee. So the guarantee becomes secondary. The primary obligation is underlying transaction, right? So when I explain some example, you will have a better understanding. Demand guarantee or guarantee means any signed undertaking, however named or described, providing a payment or presentation of compliant demand. So when you make a compliant demand, that means when you make in writing a letter demanding the guarantee, that become a compliant demand. You will be immediately paid. So that will become a demand guarantee. Guarantee means the party issuing a guarantee, including party acting. So the party means the banks who give the guarantee become a guarantor. Who is the beneficiary means the party in whose favor guarantee is issued become a beneficiary. Simple, right? So the guarantee, who is become a beneficiary? If I am getting a guarantee in my favor, so I am the beneficiary. So if the guarantee is issued in favor of somebody, so in LC, LC issued in favor of the beneficiary. He also guarantee also issued in favor of the beneficiary. That person get the benefit out of the guarantee. So he is assured. So generally, an employer become a beneficiary because the employer trusting a contractor to do a job. If the contractor doesn't deliver the job, the employer suffering. Therefore, the employer become a beneficiary. The contractor become applicant because he has an obligation under which he has to deliver under underlying relationship. If he fail to deliver, there is a financial loss to the employer. So the employer can claim it under the guarantee. Therefore, when he gets a guarantee, the employer become a beneficiary. So you should know the terminology: applicant, guarantor, underlying relationship, beneficiary. So if you know this terminology only, when I'm explaining to you, you will have an understanding. If I overlook this URDG and just go and explain to guarantee, you might not get the clear picture. You need to know who are these people, what is their relationship, why applicant coming in, what is underlying. When I say underlying relationship, you know there is a transaction between two parties. That is underlying transaction. That has nothing to do with the guarantee. Guarantee comes in as a secondary. Underlying transaction, the guarantee refer the underlying transaction in the guarantee. That is the underlying transaction. So when I explain some example, you will get a better, right? Article 2 definition, counter guarantee. Counter guarantee comes in. Here, there is something called counter guarantee comes in. At this moment, I will stop it. When I'm explaining, I will explain to you counter guarantee and the counter guarantors I will explain to you after I'm explaining the Demand means signed document by the beneficiary making a demand, right? Counter guarantee, I'll explain little later when I explain the diagram. Then you will have a better understanding. Compliant presentation means when a guarantee says the beneficiary can claim as per these terms, there is no condition. It's a demand. The beneficiary submit his demand in writing, that become a compliant presentation. So uh, uh, there is always when there is a demand made on the guarantee, it become a compliant presentation. So Article 2 gives the definition. Article 5, this is very important. Independence of the guarantee and the counter guarantee. What do you mean by, I told you guarantee is independent. A guarantee is by its nature independent of the underlying relationship. It's very clearly said. If I am giving a guarantee, the guarantee is given based on an underlying relationship. The underlying relationship is the contract. This guarantee is separate independent transaction. This is only comes in if there is a default in the underlying transaction. If there is no default, this is only piece of paper. So the guarantee only become piece of paper if nothing happen in the underlying transaction. Simple as that. That is what you call guarantees a contingent liability, right? So we will, I will explain what is contingent liability mean. It is simply piece of paper if the underlying transaction going through the way it is expected, the way both parties agreed they are doing the transaction, the guarantee is just not coming into the scene at all. The guarantee can only come in when there is a non-performance, when there is a non-payment, when there is a default. Only guarantee comes in. So that is the key. Guarantee only become effective when there is a default in the underlying transaction. So you can see when there is no default, guarantee will not come. Guarantee just a piece of paper, right? Now see, when you take insurance, insurance is a piece of paper as far as you ride the car without any problem. But you meet with an accident, then insurance become handy. Why you need to claim? Simple as that. Insurance is just a piece of paper in your car, in your wallet, as far as you ride the car carefully, meeting all the rules and regulations. Then it's a piece of paper. It's not required. But if you apparently meet accident, you are financially losing, now you are going to claim it under insurance. Think of that scenario. Think the same theory will applicable in a guarantee also. Is it just a piece of paper as far as the underlying transaction is taking place smoothly? But if the underlying transaction has some issue where one party is suffering, then that person can claim it under the guarantee. So that is what guarantees become very handy or very good to facilitate. You can bind somebody to deliver. You better deliver this. If you don't deliver, I'm going to claim it. So you can always binding the person by taking a guarantee to ensure that other party is delivering what is expected. So it's an independent nature by both a guarantee and a counter guarantee. Both are independent in nature. That is what this article explains. So uh, I'm just going through these articles for you to have basic idea. When I'm this has article 6 says document versus goods and services of performance. So guarantee can be documents versus you have to supply. Whenever there is a claim, you have to make the document in writing there is a claim. That is what you call document versus goods, services or performance. So this is where the guarantee article talks about. The guarantee deal with documents and not with goods or services or performance. Yes, guarantee only deal with document. When there is a claim, you can make a claim. When there is a default, you are making a claim. So that is what the guarantee talks about. So guarantee become only valid, only become enforceable when there is a claim. So you have to make the claim in writing. So that is where the documents. It is not about the goods, not about the services. It is only documentary claim you are making on the guarantee, right? Extend or pay. So Article 23 say whenever there is a guarantee, you need to extend it. If not, you have to pay. If you don't extend it, you need to pay. So each guarantee when you issue, there is an expiry date. Remember, it's not open-ended guarantee. When you issue a guarantee, if you take an insurance policy for your vehicle, it is 1 year maturity. Same way, when you issue a guarantee, it has a 1 year expiry or 1.5 year or whatever as per the agreed terms. There is expiry date after which it's become, if you want extended, you have to extend it. If you don't extend it, and if there is a payment to be made, you have to make the payment. So extend it or pay. That is what articles say. You need to extend it. In the event if you are not decided not to extend it, then you need to pay. Or it become after extension is not required, means guarantee become null and void. There is no extension is required. So if there is no extension is required, there is no requirement for extension. It's only required in the guarantee. There is a requirement to extend it, or if there is no extension, the person can claim it under the guarantee in the event if the enforceable contract in force. If the enforceable contract coming into the end, the guarantee becomes just null and void, become null and void. So that is what Article 23 talks about. Governing law. So the governing law, when you are applying URDG, it says governing law. So the governing law is something you need to be careful of. So it says, unless otherwise provided the guarantee, the governing law shall be that of the location of the guarantor's bar. That means the whoever issuing the guarantee, the guarantor's country law will applicable. If the guarantee is issued by a bank in Sri Lanka, it is the Sri Lanka law will applicable. If the counter guarantee is issued by a foreign bank, it is the foreign bank branch in Germany issued, it is the counter guarantee enforceable in the German office, their branch, Frankfurt or wherever. That is the governing law. So it says simply, if the guarantee is issued locally by a local bank in Sri Lanka, the guarantor's country law will apply. So any dispute between the beneficiary and the guarantor, it will be law applicable to the local law because the local bank issued. So where the location of the guarantor, that is what you understand. Location of the guarantor's branch, right? So that is what the guarantee is talking about. Governing law will be. So in Sri Lankan context, if you are using a local guarantee, there is no require any guarantee we issue Sri Lanka. Our law will apply. Our local law will be applicable. Commercial law or whatever law will applicable. But when it comes to international law, this is careful. So let me explain to you. There are two types of guarantee. So one is direct guarantee, other one is indirect guarantee, right? Right. First of all, I will explain one example for direct guarantee and one example for indirect guarantee. Then you will have you will get a idea what is direct guarantee, right? Let's say there is an underline. I'll give you an example. Then I put the diagram, right? Let's say there is a contract. Let me put this also first of all. Direct. We are talking about a direct guarantee, right? There is a buyer, seller. So I'm just taking example, just an example. There is a buyer, there is a seller. A local. This is I'm talking about direct guarantee. Don't worry about local or just focus on direct guarantee. There is a buyer, seller. Let's take example. I'll take example as a seller. Take example Nestle. Nestle import this milk powder, all this, right? They are the seller. There is a buyer who is buying directly from Nestle on a credit basis. So the underlying contract. So each party, the seller will supply commodity to buyer. So Nestle is the seller. The buyer is the local distributor. So the buyer, he buys, he's a warehouse, he buys and distributes the retail shops. So he's become a distributor, or you may call it as a buyer or distributor. So there is a contract between Nestle and the distributor. So what happened here? What is happening here? Remember, guarantee only comes in when you do transaction in cash. There's no guarantee required. So whenever there is a obligation, whenever there is a commitment, whenever there is a credit period, the guarantees comes in. So now see, there is obligation here. What is obligation? Now Nestle is saying, the seller says, Nestle says, okay, I will give you 1 million worth of goods to you on a credit basis. You have to pay me after selling the goods. You have to pay me, right? So seller, Nestle, importing milk powder, giving consignment of milk powder to the buyer on a credit basis, maybe 2 months credit period. 1 million worth of goods are given to the local buyer. So local buyer will take the 1 million goods and he will put it to the retail. He's a distributor, right? He has a vehicle, he has a fleet of vehicle, he go and distribute to the retail shop, collect the money, and as agreed, he will pay to the Nestle. As far as he is paying to the Nestle, there is no problem. But Nestle, how do they know whether this particular distributor always will meet his commitment? They never know. If he keep all his promises, well and good. But in the event, if the buyer doesn't pay after taking 1 million worth of goods, he only paid 600,000. He has to pay balance 400,000, which he is not now paying. Now, as a result, who is suffering? The seller is suffering. The Nestle company is losing 400,000 only from this particular distributor. Is it a financial loss? Yes, it's a loss. Now, how do they mitigate this loss? How do they mitigate this loss? They will ask before they give the consignment. They will tell him, "I want a bank guarantee from you." So this guy now going his bank, asking his bank to issue a guarantee. So he's become applicant when he the one wants a guarantee. So he's become applicant. He's giving his instruction to his bank. Is the bank going to issue the guarantee? He will ask his bank, "I want a guarantee to be issued." Let's say this is a Nestle, this is a local distributor, his bank is Bank of Ceylon. So he will go to his Bank of Ceylon, ask him, "Bank of Ceylon, I want to issue a guarantee favoring Nestle for 1 million rupees." So again, same thing, the facility, like LCs, he should have a facility. If he has some money, they will he give an instruction, they will take his money, and they are going to Bank of Ceylon going to issue a guarantee. Issue a guarantee. They have become a guarantor. Bank of Ceylon become a guarantor. Guarantees issued favoring Nestle. Nestle become a beneficiary. Now, Nestle has the guarantee from Bank of Ceylon for 1 million up to 1 year. Now, Nestle keep the piece of guarantee in their file as far as this particular buyer keeps on making the payment as promised. The guarantee is just a piece of paper. The moment buyer doesn't make the payment on the future date as agreed, he's trying to default now. Now beneficiary will tell him, the seller become a beneficiary. If they got the guarantee now, they will tell the applicant, "Look here, you have given me the guarantee. I am going to claim it under the guarantee. It's a demand guarantee. I don't have anything. I just simply make a claim against the guarantee. It's a simple, plain demand guarantee." So Nestle will put the guarantee. When the guarantee is issued, there is a reference number to the guarantee. They put the guarantee reference number. Issued by Bank of Ceylon, they address to Bank of Ceylon, put the guarantee number and the value. They will say, "As per this guarantee, we are making our claim of let's say he has to make 400,000. He has not paid 400,000 under the above guarantee. Since the applicant is not meeting his financial obligation, is failed to meet the financial obligation, please credit our account." Simple letter along with the guarantee, they send it to Bank of Ceylon. Bank of Ceylon has to immediately make the payment to the Nestle. No second word about it. But in practicality, how it happens when there is a default by the distributor, where he has out of 1 million, he has paid only 600,000, there are 400,000 to be paid. Now he says, when the Bank of Ceylon got the claim from the Nestle, Bank of Ceylon asking, "What happened? We have issued the guarantee, there is a claim, 400,000. What are you going to do?" He immediately will talk to Nestle, "Give me 1 week time, I will pay you. Give me 1 week time, I will pay you." But they will keep quiet. They will not tell anything. The guarantee is already claimed because the guarantee is going to expire. That is the reason they claim it. The guarantee has the validity period, they would have given time. But the guarantee is going to expire on the 31st of, let's say 31st of January. Guarantee going to expire. So before they have to lodge the claim. So that is why they lodge the claim, outstanding 400,000, they lodge the claim. Now, Bank of Ceylon informing applicant, "Look here, there is a claim against the guarantee we issued on your behalf, 400,000 from Nestle. What are we going to do? Are you going to, shall we debit your account?" He will say, "No, no, no. Wait, I'll give you instruction." He will immediately talk to Nestle, asking Nestle to give time 1 week. He will pay that. So Nestle will keep quiet. Before they already lodged the claim. So what will happen? Applicant will make the payment to Nestle. He will immediately make the 400,000. Nestle asks the Bank of Ceylon, "We withdraw our claim. We withdraw our claim." So simple. So you can see how comfortable Nestle to bind this particular person. So Nestle has no problem. They can give it to island-wide distributor any amount of goods after taking a bank guarantee. So this is called direct guarantee. So now you know the word. Underlying relationship is a contract between these two parties, right? Applicant, the person who's supposed to meet the obligation. The applicant has to make the payment. That is the underlying contract. Because the beneficiary has given, the seller has given the consignment of goods. The applicant has agreed after 3 months he has to make the payment. As far as he's making the payment as agreed, just guarantee just a piece of paper. Beneficiary will just keep it with them. It is only enforceable when there is a default by the borrower or the buyer. Then only they will enforce it. Until such time it's piece of paper. That is the reason the guarantees are considered as a contingent liability. It is not a real liability. And now you can see that it is a independent transaction. You can see underlying contract is to supply milk powder and he has to pay after 3 months time. That is the underlying contract. Guarantee is just a independent, just a separate transaction guarantee, just to support this underlying transaction. That is the reason we learned this is an independent transaction. But although it's referred to the underlying transaction, the guarantee by nature is independent. The primary transaction is a contract. So now you know direct guarantee. Why we do call direct guarantee? The guarantee issued by the directly guarantor to the beneficiary. That is what you call direct guarantee. So classic example of the direct guarantee is where the local supplies, right? So we will take an example for an indirect guarantee. So you can write if you so that is become a guarantor. So this is the direct guarantee. Example of direct guarantee you can write down local supply. So you can say local supply. Let you take example export company Nestle supply goods on a credit basis to the local distributor. Nestle, an export company, Nestle, not export company, Nestle, uh, import of commodities, import of milk powder or import of commodities, Nestle import of milk powder, supply goods to the local distributor. Supply goods to the local distributor. Supply goods to the local distributor on a credit basis. On a credit basis. On a credit basis against a bank guarantee. On a credit basis against a bank guarantee. So here you can see the applicant is the local buyer or distributor is the applicant. Nestle is beneficiary. The bank who issued the guarantee become a guarantor. So these are the example of a direct guarantee. So the underlying transaction is supply of milk powder. That is the underlying transaction. So as far as underlying transaction, it's a credit transaction. That means Nestle has given a credit period, 3 months credit period. So if the Nestle buying a cash, if the Nestle selling the goods on sale, there is no bank guarantee. If the Nestle wants a bank guarantee because they are giving on a credit pay, because this guy has to make the payment after 3 months. So there is obligation. So he has the financial obligation to repay. If he doesn't repay, what will happen? That is what Nestle thought about. That is what Nestle insisted for a bank guarantee. So the bank guarantee issued in favor of Nestle is beneficiary. The local distributor is become the applicant. The distributor's bank become issuing bank or the guarantor. Right? That is the example. Right? Now I'm going to explain to you an indirect guarantee. So this is where both guarantees type. One is direct guarantee, other one is indirect. I will give you an example and then I put the diagram. Then I will explain once the diagram. Just take an example. We will take a simple example. Let's say Sri Lanka Telecom. Sri Lanka Telecom want to upgrade their telecom line. So it's a 100 million worth of projects. 100 million worth of project to upgrade the entire telecom line island wide. So this contract will be floated internationally because we don't have any local company to upgrade the telecom line in Sri Lanka. So SLT is the service provider island wide giving communication lines, telecom lines. So upgrading telecom line is a 100 million worth of project. It is floated internationally because we don't have, because what happened, SLT can't find any service provider locally. So they have to go internationally. So they will float a tender. You know what is tender, right? When you want to buy goods or services in large quantity, you don't search a buyer or you don't search a contractor to do this one by one. It's time consuming. You need to, every time you have to talk to person, it's lengthy. So it's simplified process. It's called for a tender. The tender can be applicable to even local. Say a government has a school. There's a schools. You have used furniture, so you are disposing and try to get a new furniture. So you call for a tender and you float a tender in the paper and say, we are supplying, there is a tender, we want to sell used furniture, 1,000 chairs and tables. You put a tender in the paper, local paper. It's a local tender. So whoever want to buy the furniture, want to take the wood out of the furniture made, they will apply. Everybody apply and say, they will say, what is, please quote your price. This is, even you can, there is a display, you can come and see the desk and chairs if you want. They will display it in one place. People who want interest to go and see, and they will apply for the tender. Everybody respond to the tender. So everybody quoting their price. Whoever quoting higher price, the school will sell the used chairs and tables. Simple as that. When you want to purchase or when you want to sell, always the best way is to get a good pricing, float a tender. So here SLT floated a tender to get a service provider efficiently can make this entire 1 million, 100 million contract. They can do it. The international reputed company they're expecting those. Therefore, they are gone and internationally put a tender. Now, different contractor. There are 3 contractors from European country, one from Japan, one from USA. 5 people apply. There are 3 European countries. Let's say Germany, Italy, France. 3 companies apply, and one of the Japanese company apply. One of the USA company also interested. So 5 people are applying. Right. Now, SLT, when they float this tender, they said 100 million worth of project. Now they want a guarantee to be issued. Uh, when they float a tender, remember, they have put a condition in the tender. Whenever, whoever applying for this tender, they have to submit a bank guarantee with, you call it as a tender bond or bid guarantee or bid bond. When you are bidding, you have to support with your tender documents 1%, generally 1%. So 100 million mean 1 million worth of guarantee to be also attached. So SLT put a further condition and say that that particular 1 million guarantee to be issued by a local bank in Sri Lanka. They have also said the guarantee to be issued by local bank in Sri Lanka, because SLT can't deal with foreign banks. They want the guarantee to be issued by local bank. Right. Now, the German person want to apply, the France person want to apply, maybe Italy person want to apply, and the USA and the Japanese, all people want to apply. Now they are looking for a local bank in Sri Lanka because they want to issue the guarantee through the local. That is the requirement of SLT, Sri Lanka Telecom. Now they are approaching maybe the Japanese bank dealing, having correspondent relationship with Bank of Ceylon. They are approaching Bank of Ceylon, asking Bank of Ceylon, can you issue a guarantee against our counter guarantee favoring SLT for 1 million? What is your price? So Bank of Ceylon will quote a price. Okay, we can issue a guarantee, SLT against your counter guarantee. We will charge you 1% commission. Then likewise, all 5 contractors will approaching the local bank. All the local bank will quote a price, and the local bank will issue the guarantee against the counter guarantee. Now let us look at this diagram now. Now you know what is the underlying transaction, right? Now let's see. There is an employer, there is a contractor supplier. Who is the employer? Which is SLT. Remember, the employer is SLT. The contractor supplier, there are 5 suppliers. All 5 are suppliers. We never know who is going to get it, right? There are 5 suppliers initially. What is the underlying contract? To upgrade the telecom line. What is the value? 100 million. What is the requirement by the employer when somebody want to do this contract? They have to submit the bid bond for 1 million with their tender documents. Now the contractor approaching, the contractor become an applicant in the guarantee because he has to he wants his bank to issue a guarantee. So he will giving instruction to his bank, that is his bank. Let's say his bank in Germany. So the bank, the service provider, let's say there's one of the telecom company, one of the leading company in Germany who do the telecom lines. They want to issue this guarantee because they want to apply for this tender. So they go to their bank, giving instruction. We want to issue a guarantee favoring SLT in Sri Lanka. There is a condition: the guarantee has to be issued by one of the local bank in Sri Lanka. So can you find out a bank? They are asking their bank. So their bank has already communicated with the Bank of Ceylon. They said, yes, we can issue. So now what will happen? They are the instructing bank. They will issue a counter guarantee to a counter guarantee. When they issue a counter guarantee, they become a counter guarantor. They will issue a counter guarantee to Bank of Ceylon. This is the bank in Sri Lanka. They are the issuing bank. So they will, the German bank giving a counter guarantee, telling Bank of Ceylon, can you issue a guarantee against our counter guarantee? In the event of a claim, you can claim it under our counter guarantee. So they are giving a counter guarantee to Bank of Ceylon to issue a guarantee favoring SLT. Bank of Ceylon agreed. Now Bank of Ceylon going to issue a guarantee. They become a guarantor. The SLT become a beneficiary. Now see this underlying transaction absolutely without any problem. SLT has no problem to find a contractor. Simply, what they only insisted when they say when somebody want to do this contract, they have to give a bid guarantee for 1 million. Why they ask for a 1 million bid guarantee? Because they are spending a time to look for the right person to do this project. There are 5 people applied. They spend a lot of time. They will have a technical committee. They will have other committee, procurement committee. They will have to go through these tender documents and see who is the appropriate contractor. They want to select it. There is a time consuming. There is a lot of money spent. All that happens. Suppose say when they select the person, select the contractor, and when they want to sign a contract, now the particular contractor says, no, the prices have gone up. We are unable to sign the contract for 100 million. We want 110 million. So don't you think this SLT going to just keep quiet? Because SLT spend a lot of time. That is what SLT wanted when somebody applying for a contract. They want a tender. When they apply for a tender, there is a bid guarantee to be issued. So that bid guarantee is there for 1 million. If they don't sign the contract, they will claim it under the bid guarantee. So therefore, now the contractor in Germany is agreed. When they agreed to apply, submit the tender bond with the tender document, they are obliged to sign when they are selected. Likewise, there will be 5. Now you can say I have given one example. Likewise, there will be 5 guarantee will be issued. One is Germany, one is Japan. For the same example, there are 3 European companies. They all get issued. One USA company. Everybody issuing. The SLT will get 5 guarantees, 5 tender documents. They will open. They will finalize, and they will select the German company. They will shortlist out of 5 2, and they finalize Germany. Other 4 guarantee will become null and void because there is no claim. That is be cancelled. Only they know. German company only going to do. Now they will ask the German company, okay, we have selected you. Now we are going to sign the contract. So you have given a bid bond, right? Now let us see type of most frequently issued guarantee. Now you can see there are 4 type of guarantee you can learn. Bid bond, which is submitted with the tender documents. You call tender guarantee. Then you have a performance guarantee. You have advance payment guarantee. You have a retention guarantee, right? What is been also known as a tender guarantee. A written guarantee from a third party, usually a bank, submitted to a principal contractor submitted by a contractor with the bid to perform a contract, right? It is willing to bid, right? To perform a contract, right? Bid bond ensure that acceptance of bid by the principal. So whatever principal agreed, he has to do the contract. He can't go back his word, right? Right. Now you can see if the contract is awarded, he has to replace the bid bond with a performance bond. The bid is up to the bid level. Once the bid is finalized, the bid is become null and void. Now the bid bond need to be replaced by the performance bond, right? So you can see there is a sequence of guarantees, right? which are connection. Each one has a connection. So starting from bid bond, next level is performance. Now what will happen once they selected? All other 4 people gone. All other 4 people not selected. Only the person who selected has to replace the tender bid bond with the performance, because he's the only guy going to do the contract out of 5 people, right? Then, if the contractor does not accept the awarded contract, right now, see what is happening. He has agreed to do the contract for $1 million, $100 million. Sorry. Now he has to sign the contract, right? If he doesn't sign the contract, they will claim. So generally, you can see the guarantee, the tender value, bid bond value, 1 to 5%, because when you're issuing a guarantee for 100 million worth of project, it's starting from 1%. Is everybody will apply, because 100 million, 1% is 1 million, right? Because if the percentage are higher, less people will apply, because the contract value is 100 million. 1% of the contract value become a bid value. 1% of the contract value. So 100 million, 1% is 1 million. So do you mean to say, when you apply for, when you are giving a condition in the tender document, 10% 10% of the contract value to be given as a bid bond, mean you don't get anybody applying, because larger value, they have to pay commission, substantial commission. So always bid bond is lower percentage, because this is a inception level. You are asking people to bid it. The people will bid it when the lower price is there, because the guarantee commission based on the value, they have to pay commission. There's a substantial commission involved. Remember, all other 4 people who have paid the commission didn't get anything. See, 5 people applied, only 1% got the contract. All others didn't get it, because that is the additional expenses for those 4 people. Suppose say they apply for 5 million worth of guarantee, they have to pay more commission. Since this is 1 million only, they apply. So the lesser the bid bond, you get more people to apply. Understood? Right. That is how the bid bond, right? So bid is then come performance. So once a bid bond is, once you sign the contract, you need to replace the bid bond by the performance bond. So you can see, again, the same route will apply. The same route will apply. Same what I told you. Once the contract is signed, the bid is given. Okay, now the contract will be signed. Now the SLD is telling the contractor, German contractor, okay, now the bid becomes null and void. You replace the bid bond by a performance bond. Now you could see the performance bond value should be definitely more than that, because they are awarded the contract. So they need to ensure this guy perform better. So they need to bind this contractor by increasing the percentage of the contract value. The performance guarantee proportion should be more. Then only they will put the performance. Now see what is the value. Generally comes as 5 to 10, 10 to 15%. So larger value. They have to give 15, or if it is a 10%, 10 million worth of guarantee they have to give for the performance guarantee. 10% of the contract value, which is 100 million, 10% is 10 million. Now the 1 million bid bond become null and void when they give the 10 million performance guarantee, because the performance guarantee replaced the tender. So you also could see the tender bond is short tenor, 3 to 6 months only the tender. The performance guarantee longer tenor, because this project going to be run for next 3 years. So the SLT want to ensure this particular company going to deliver a solid job over a period of 3 years. So they want the performance guarantee for a longer period. Depending on the nature of the contract, if it is a lengthy 3 years period, the performance guarantee also will be issued for 3 years period. So you can see performance running up to larger value, longer tenor, because this is cover the performance of the contractor. Any given point of time, if the contractor delaying, or their jobs are not as expected, because when there's a project, the SLT will appoint a project manager. So the project manager check the each project level, and he will sign. Whenever there is a job completed, the contractor will ask the project manager, will you accept this stage of work completed? He will experiment, and he said, we accepted, we are satisfactory. So that job is completed. So each job is completed, SLT has to make the payment. But they will make the separate payment, but only they keep the percentage of 10% as a performance to keep them binding. In the event if they don't do the proper job, or when they are delaying, they will threaten the contractor. We are going to claim it under the performance guarantee because you are delaying. Or they might say your job is not expected level. We are going to claim it. So the contractor will immediately attend to it. He knows if they don't do it, there will be claim. how the claim will be worked? SLT will make the claim to Bank of Ceylon. Bank of Ceylon will not. I'll just show the diagram here again. Look at the diagram here. How it works here. Here, the beneficiary SLT will claim it to the issuing bank. They will send a claim to Bank of Ceylon. Bank of Ceylon will send a claim to the German bank against their counter guarantee. The German bank will ask this person, there is a claim 10 million from Bank of Ceylon, SLT beneficiary claiming, what are you going to do? He will say, no, hold it. I am going to talk to them. Then they will talk to SLT. They will have a local agent. They will go and meet SLT people, and they will come to compromise. Okay, please withdraw the claim. We will do it. So if the SLT is getting something in writing from the contractor, SLT is now have a comfort. Now SLT may say Bank of Ceylon, okay, we are withdrawing our claim because this contractor has agreed to do that, redo the job or try to expedite whatever the reason they claim it, that will be fulfilled. So you can see each level is well monitored by SLT by getting a guarantee. So they are tightening their screw to ensure the contractor is delivering the expected job at the expected level. So you can see the valuable of the guarantee usage. You can see, right? That is where the performance guarantee, right? So we saw the bid bond, we saw the performance, which is generally 10%. Performance bond replaced the bid bond. Yes, the performance bond replaced the bid bond, become null and void after contract is signed, right? Now, advance payment guarantee. What is this? Sometimes what happens? SLT has to make an advance payment to the contractor. They also make other 10 million payment. So they will say, okay, when we are making an advance payment, we want an advance payment guarantee from you to ensure that this money is used to do our project. So now see, every level they are taking a guarantee to cover themselves. When they are making an advance payment before the work done, before they start the job, they are making an advance payment. So there's a risk for SLT. What will happen if the German company doesn't deliver the job? So they send the money, getting advance payment only send the money. So when the advance payment guarantee is received, they will send the advance payment. So the German bank has to use the same channel to issue other guarantee called advance payment guarantee for 10 to 15 million. There again, that also same range of 5 to 15%. So when the advance payment guarantee is given, now the SLT will send the money. They will ensure, the contractor will ensure they use this money to do the project. They can't use it for anything else, right? So understood, right? That is the advance payment. It has a reduction clause. The advance payment has a reduction clause. Why? Whenever they have given the 15 million advance payment, contractor has given. Now the contractor has completed out of 15 million, 10 million worth of work they are completed. It is no point blocking their bank facility because they are German bank blocking the facility and given 15 million worth of guarantee. Now they actually 10 million worth is already completed. It's only 5 million work is uncompleted. So the guarantee value will be reduced as per the performance of the work is done. So advance payment guarantee always has a reduction clause, right? Whenever job is performed by the contractor, they will ask the beneficiary to reduce the guarantee value. Beneficiary will definitely agree because though they send the 15 million, now 10 million worth of work is already completed. The project manager confirms work is completed. So they no need to necessary to keep the 15 million guarantee in their books. 5 million is enough. So they will not object for the value reduction. They will agree for value reduction. The guarantee will be gradually reduced according to the work performance, right? That is advance. The last guarantee we are talking about, retention guarantee. What is this? Why the retention guarantee is kept? Say everything is over. The contract is after 4 years, everything over. Now SLT will not release the last payment, that is 1 million. They are keeping 1 to 5 million. Let's say 5 million, they are keeping it 5 million, 5%. Let's say 5%. 5 million, they are keeping 10. Telling contractor, you have done everything. We have paid you 95 million. Only 5 million we have to make the payment. But we will make this last payment 5 million. We want the retention guarantee from you. What do you mean by retention guarantee? So they're asking why that? No, we want the retention guarantee. If you send us a retention guarantee, we will send. So they will send the retention guarantee. The SLT will remit the money. The entire money is remitted now. But SLT has the retention guarantee. Why they have gone for a retention guarantee? Is to ensure the project is over by 4 years. Now, when they implement, when they try to give this line to the consumers, there are complaints. The line is distorted, there the line is not clear, there are certain disturbance, there is a technical issue. Now see, if they don't take the retention guarantee, the contract is vanish. They will ask extra payment to do the repairs. By retaining this retention guarantee, they will ask the guy, look here, we have 5 million retention bond with us. There is a defect, can you attend to? Immediately contractor will come and do the repairs. So when the retention guarantees, they are all whatever after implementing the project, if there are certain work to be attended, repairs or some sort of whatever balance work to be completed, there is a 5 to 10% retention bond percentage is there. So you keep that 5 to 10%, ensure the entire job is fully satisfied. Then the guarantee, you release the guarantee. You don't want the guarantee because you checked everything. Now you return the guarantee to the bank. We are not interested. Then the guarantee is over. So you can see how the guarantees are valid, yeah? How the guarantees are used internationally, right? It's very, very important to know this, right? So the usage of guarantee. So now you know the retention guarantee, tender, bid bond, performance, advance. These all four are indirect guarantee. Why you call indirect guarantee? Because there is other bank issues. It is not a directly German bank issue. It is a Bank of Ceylon issue. Therefore, it's a indirect guarantee, right? So what is contingent liability? As I told you, guarantee is a contingent liability. What do you mean by contingent liability? It is a liability which may arise, you can see, depending on the outcome of a uncertain future event. What do you mean by depending on? Now see, why do we call it this contingent liability? Now we were talking about tender, bid bond, performance, retention. All these SLT keep it in their file. As far as all the payment, all the jobs are delivered by the contractor as expected, all these piece of paper, only this piece of paper become valid if there is a contractor defaulting the contract. When the contract is not delivering the expected performance, then there is a claim from the beneficiary. Now, SLT will only be claiming when there is a financial loss if they incur as a result of this contractor not doing the project. That is what you call contingent liability. So, contingent liability comes as a off balance sheet item. So you call it, this doesn't reflect, it's a online balance sheet. Why? There is no physical movement of funds. Online balance sheet mean it is appearing in the balance sheet. So the real liability only appearing in the balance sheet. This is contingent. We never know when this become a real liability. Therefore, it's considered as a off balance sheet item. It will not reflected in the balance sheet of the bank. So likewise, contingent liabilities are kind of example I have given. Potential lawsuit, product warranties, bank, even you can write letter of credit, even LCs are contingent liability, letter of credit, issuance of bank guarantee, pending potential lawsuit. Sometimes when there is a case, there's a court case going against a company, we never know the company will win the case. So they need to keep a certain amount of money because you never know whether there will be. That is called contingent liability. Product. Sometimes you give a product warranty, 2-year warranty. You never know whether the product user will come back and ask you for the service. They might not come. They might come. So therefore, it's considered as contingent liability. All right. I have also taken few slides on new trend in international trade, right? Foreign trade, new trends. That is, you should know. Now the countries are liberalizing their cross-border restrictions. So liberalizing of cross-border transactions. So they remove the restriction. They are coming people to, they want everybody to coming into the global market so that their people can consume all the goods. So the restrictions are removed by all the nations. That is one of. Then the cooperation among countries. I think we learned this, right? SARC and country regional corporations are extended to boost the economy, right? Whenever there is a barrier, you open the barrier, other people to come into your country. That is also cooperation among the countries. Uh, emerging markets. You know what is the growth of emerging market now? Like take country like India, emerging market. Turkey is one of the emerging market. Even China, they are emerging to all over the places, right? Mexico. These are the country emerging. Even for that matter, Bangladesh is one of the emerging. They are also booming garment industry. Unfortunately, we also should have been there. Unfortunately, we lost our position. We are no more emerging market. We are just under that, right? We lost our emerging market position because we don't have much of a product range to sell it. So we don't come as emerging market, but most of the Middle Eastern countries, UAE, all become emerging market. UAE, even Russia, Mexico, all these people are emerging market, right? So they all growing. Even for Vietnam is growing, right? So these are emerging market. Transfer of technology. Yes, you when you have a latest technology, by getting into the trade, you share that technical to other people, right? Now, see, we are using all this new technology, Mobitelecom, SLTcom, all this is used in overseas country. By incorporating that, we are using this technology. Now, I am talking to you uh, online. This is the technology we adopted, introduced by foreign country, we are adopting, right? So that is that is that is something you need to understand. These are the some of the new trend in. So new trend in liberalization of cross borders. Yeah, I've given some example. Huh? You are remove these restriction cross border movements. Uh, Provide consumer better, greater variety of goods. Yeah, when you remove when you open the door, you can consume all the commodity that is at a lower cost, right? So you can now see when you open the market, all these Chinese decorative item, everything coming to Sri Lanka during the seasonal time, right? All are manufactured in China, very cheaper. So it's better bring down those goods rather than importing. That is where rather than manufacturing here, it might expensive because we don't have this raw material to manufacture these cheaper goods, right? So that is where China is dominating, right? So that is cross border. Cooperation among countries, yes, you have these countries have a restriction. Uh, you are permitting other developing country to coming into the market by removing restriction, giving concession, giving open the door for them. So there are trade treaty among the Sri Lanka as a trade agreement with Indo-Ceylon, then India, Indo-Pakistan, Sri Lanka agreed with Pakistan, and the Singapore one is pending. But we got into the regional wide SARC and all. So you know these are countries supporting other country to get the benefit by joining as a region, right? So World Trade Organization is a global body facilitating the trade between nations. So WTO, World Trade Organization, is issuing the right. Growth in emerging market. Yeah, emerging market is something the country that are uh, constantly developing, right? Progressing, developing. So the constantly they are developing. Their economies well advanced. Like example of Turkey is well advanced now. Countries like Mexico, Brazil, all these are developing emerging market. They're capturing into unknown territory. That is growth of emerging markets. That is one of the trends for you to facilitate the international trade, allowing new players to coming into the market, so that you will have a larger size market, access to larger market, right? That is what transfer technology. Yeah, your data, all that, what the technology we are using because of the international trade. Otherwise, we won't be able to use this latest technology without importing from other country, right? So we have a data warehouse, all these we are latest technology we are using just because simply because other country invented, we are buying that and using that. So otherwise you won't be able to do all these things what we are doing currently, right? That is we call transfer of technology. I think that ends my session. So it's a Q&A sessions, right? So I have taken few questions, right? Multiple questions. Shall we quickly go through what is the international payment method which provides the maximum benefit to the importer? Maximum benefit to the importer. Letter of credit, documents again, acceptance, open account, advance payment. Which is the answer? What is the international payment method which provides maximum benefit to the importer? What is the answer? Maximum benefit to the importer. Which one? Importer. He get the goods, later he will pay. What is the term? We learn today. What is the answer? We learn today. Open account, right? What is the international payment method which provides the maximum protection to the exporter? Maximum protection to the exporter. Which one? We learned today that also. What is that? Yes, advance payment. Yes, you know that, right? Advance payment. Maximum protection to the exporter is get the money well in advance, right? Okay, let's see you all can answer this question. In financing international trade, the term with recourse is generally used. What does it mean in lender's perspective? With recourse. Lender has the legal right to seize the borrower's asset in the event of a default. The borrower has the right to refuse the lender's claim on assets. The lender doesn't have the legal rights to claim the borrower's assets. Both the lender and the borrower do have the legal rights. What is the answer? In financing international trade, the term with recourse is generally used. What does it mean in lender's perspective? When the lender says with recourse, what does it mean? When a bank says, I'm giving you advance with recourse, what does it mean? What is the answer? You can think and tell what is the answer. When they say with recourse, can they have the right? Can they have the right? Yes, they have the right. Lender has the legal right to seize the borrower's asset because they say with recourse, I can come back to you. I can claim in the event of a default because I am giving you with recourse. That means I can come back. When he says without recourse, he can't go back. So the borrower has the right to refuse the legal claim on the asset if it is a without recourse. Answer without recourse, the second one is correct. With recourse, the first one is answer, right? The usage of indirect guarantees become essential in the following terms. We just studied indirect guarantee. The following circumstances. Guarantees are issued between two parties within a country. Indirect guarantee, you know what is indirect guarantee, yeah? Between two parties within a country, direct guarantee is more than enough. ADB issued a bank guarantee favoring government of Sri Lanka. Will the government require indirect guarantee or they will accept the direct guarantee issued by ADB? When a contractor overseas undertake a government project in Sri Lanka, when a local entity supply goods to a domestic distributor, which instance the essential of indirect guarantees become required? Which instance? Number 1, no. Number 4, no. Which is the answer then? 2 and 3, which is the correct answer? Can anybody tell me? Try that. Take the same example, what we learn now. Who has taken the contract? It is German tech company taken the contract of SLT. So when a contractor overseas undertake a government project in Sri Lanka, the government project in Sri Lanka means government do not accept direct guarantee. They want indirect guarantee. That means they want a guarantee issued by a local bank. So indirect guarantee means the guarantee is issued by local bank. So the answer is this, right? Okay. What is the write the difference between pre-shipment and post-shipment? This is a direct question. What is pre-shipment? What is post-shipment? What is pre-shipment? So you can see pre-shipment is, you can just, if you want, just jot down this kind of question you can expect in the exam, right? Pre-shipment is what? Finance disbursed before shipment. Finance disbursed before shipment is pre-shipment. Post-shipment, finance disbursed after shipment. Finance disbursed before shipment is pre-shipment. Finance disbursed after shipment is called post-shipment. So in pre-shipment, what are the risks you know before the shipment? There are two types of risk involved: performance and the payment risks. Involved performance and the payment risk. Involved performance and payment risk of exporter and importer respectively. The performance need to be done by exporter. The payment need to be done by the importer. Therefore, you need to say involve performance and payment risk of exporter and importer respectively. Involve performance and payment risk of exporter and importer respectively. Post shipment, the shipment is done. There's no risk of exporter. He has done the performance. So it's only involved mainly payment risk. So that is the other difference. When it comes to risks, therefore, when there are two risks, you can say pre-shipment is high risk. It's relatively high risk. Relatively high risk with high cost. It's relatively high risk with high cost. Under post shipment, you can say risk is lower. Risk is lower if the ultimate importer is a reputed. If the ultimate importer is a reputed entity. Risk is lower if the importer is a reputed entity. So very much because this is shipment is done, is a matter of getting the payment. So these are the differences you can write down, right? Okay. So you can say, and if you want other different, you can say pre-shipment is granted against the letter of credit or LCs or confirm order. Post-shipment is granted against the ship documents, right? So that is again other difference if you want, right? Pre-shipment is granted against export order or a letter of credit. Post-shipment is granted against the shipping documents, right? So those are. So simple case study. So just try. A Sri Lankan exporter has received an export LC for a value of US dollar under 50,000 to be shipped to USA. A Sri Lankan exporter has received an export LC for the value of US dollar under 50,000 to be shipped to USA. To procure this order, he needs to import raw material to the value of 65,000. And he has approached his bank for a short-term credit facility. The security offered for this facility is export LC. What is the most export credit facility that should be considered by this bank in this instance? Can you understand the question? There is an exporter receive an order 150,000 worth of shipment to be sent to USA. He comes with that LC asking the bank to finance 65,000. He need to buy some raw material. He needs 65,000. The security offered, he gives the export LC as a security. So what is the facility you offer? Is it a pre-shipment or post-shipment? What is the facility? What is the most appropriate credit facility? It's a answer the question, please. You can right or wrong, try. Because in the learning process, you need to try. Otherwise, I'm just speaking, I am just answering all the question, doesn't make reciprocal. I need something from your input. I don't know whether you are listening to this, because virtually I'm doing this presentation, so I need at least some contribution from you. Just try. What is we learn this facility. What is the facility? Yeah, it's a packing credit facility under pre-shipment first. It's a pre-shipment. You can give further specify. It's a packing credit facility, right? Name the type of charge that the bank would make to cover the exposure in the event of facilities extended. If they want to extend this facility, what is the type of charge? I think packing credit, we learn hypothecation. Yes, the charge is hypothecation. Hypothecation, right? We learn that, right? Hypothecation. What is the facility under which the exporter would obtain export proceeds upon submission of compliant set of documents to the named nominated bank after effecting the shipment? How do you call that? Compliant set of documents to the named nominated bank after effect. That is, what is the facility? Submission of compliance set of documents, negotiation of documents, negotiation of documents, right? So that is the facility you can consider. Discounting will not come in because this is the LC, so it could be negotiation of documents. That is the facility they offer, right? So negotiation of documents is the facility. So do you have any other questions? So you want to know any other things? So that ends our session. So hope that just go through the slides. Probably we will have a other session on next Saturday. That's long weekend. We'll try to see the risk element of it, how to cover this risk, mitigating risk. Then we move on to the foreign currency account. So you will probably have a 1 weekend, or not next week we will have a classes. Probably 12th we might not have. So I will keep you informed, right? So see you in the next class then.